Insurance companies' capital adequacy. The role of capital adequacy as a risk management tool in the insurance sector. The Solomon Fadden, Risk Management of Everything channel, presents Insurance companies' capital adequacy. The role of capital adequacy as a risk management tool in the insurance sector. Welcome to the Solomon Fadden, Risk Management of Everything channel. On this channel, you will see videos on risk management and its application to diverse areas and sectors. If you are new here, subscribe to our channel and press the notification button to be notified when we upload new videos. Thank you. This video discusses insurance companies' capital adequacy, and explains the role of capital adequacy as a risk management tool in the insurance sector. This video will help you understand the meaning of capital adequacy, key concepts of capital adequacy, the importance of capital adequacy in insurance companies, the importance of capital adequacy in insurance companies, computation of an insurance company's capital adequacy ratios, historical evolution of capital adequacy requirements, insurance regulatory frameworks and standards, Solvency II, regulatory frameworks and standards, risk-based capital, RBC, regulatory frameworks and standards, International Association of Insurance Supervisors, IAIS, guidelines, practical application and analysis of capital adequacy, impact of regulatory changes on capital adequacy challenges and issues, identifying and measuring insurance companies' underwriting, market, and operational risks, regulatory arbitrage and compliance costs, evolving regulatory landscape, comparison of capital adequacy across regions, sectoral and portfolio differences in capital adequacy, strategies to circumvent regulatory requirements, cost implications of circumventing regulatory requirements, the impact of economic cycles and market conditions on capital adequacy, roles of technological advancements on capital adequacy, implications of capital adequacy for insurance companies, regulators, policyholders, investors, employees, and the broader financial system. Roles of capital adequacy as a risk management tool in the insurance sector, and strategic suggestions for insurance companies to ensure capital adequacy. Now, let us start. Capital adequacy. Capital adequacy refers to the requirement for insurance companies to maintain sufficient capital to cover their risks and meet their obligations to policyholders and other stakeholders. It measures an insurer's financial strength and stability, ensuring that the company can absorb losses and continue to operate in times of financial stress. The primary objective of capital adequacy is to protect policyholders by reducing the risk of insolvency. Adequate capital is a buffer against unexpected adverse events, such as catastrophic claims, significant market volatility, or operational failures. Regulatory frameworks establish minimum capital requirements to ensure that insurance companies are adequately capitalized and can sustain operations under adverse conditions. Key concepts of capital adequacy. 1. Risk-based capital. Risk-based capital, RBC, measures the minimum amount of capital an insurance company needs to support its overall business operations, considering its size and risk profile. RBC calculations typically involve assessing various risk factors, including underwriting, credit, market, and operational risks. These risks are quantified, and a corresponding capital requirement is determined. Regulators use RBC to set capital standards and intervene if an insurance company's capital falls below the required threshold. 2. Solvency capital requirement. Solvency capital requirement, SCR, is a vital component of the Solvency II framework in Europe. It represents the amount of funds insurance companies must hold to ensure they can meet their liabilities over the next 12 months with a 99.5% confidence level. Calculation. The SCR is calculated using either a standardized approach or an internal model tailored to the insurance company's risk profile. The SCR ensures insurers have enough capital to absorb significant losses and meet policyholder claims. 3. Minimum capital requirement. The minimum capital requirement, MCR, is a threshold set below the SCR in the Solvency II framework. It represents the minimum level of capital an insurance company must maintain to avoid regulatory intervention. Falling below the MCR triggers immediate regulatory actions to restore the capital position and protect policyholders. 4. Economic capital. Economic capital is an internal measure used by insurance companies to assess the capital required to cover risks based on the company's own risk assessment and management practices. It is used for internal risk management, strategic decision-making, and performance evaluation, often providing a more comprehensive view of capital needs than regulatory requirements alone. 5. Capital adequacy ratios. Capital adequacy ratios include solvency ratio, combined ratio and capital buffer. Solvency ratio. This ratio measures the company's capital with risk-weighted assets. A higher solvency ratio indicates excellent financial stability and capacity to withstand losses. Combined ratio. In non-life insurance, this ratio is the sum of the loss and expense ratios. A combined ratio below 100% indicates underwriting profitability, contributing to capital adequacy. Capital buffer. This excess capital is held above the regulatory requirements, providing additional protection against unforeseen risks and enhancing financial resilience. 6. Risk management and governance. This entails enterprise risk management and governance framework. Enterprise risk management. Enterprise risk management, ERM, is a comprehensive approach to identifying, assessing, and managing organizational risks. It ensures that capital is allocated efficiently to support strategic objectives. Governance framework. Effective governance practices, including board oversight and internal controls, are critical to maintaining capital adequacy and ensuring compliance with regulatory standards. The importance of capital adequacy. The importance of capital adequacy includes the following. 1. Policyholder protection ensures that insurance companies can meet their obligations to policyholders, even in adverse conditions. 2. Financial stability. This helps maintain the insurance sector's stability, preventing systemic risks and contagion. 3. Regulatory compliance helps insurance companies meet legal and regulatory requirements, avoiding penalties and enhancing credibility. 4. Market confidence boosts confidence among investors, policyholders, and other stakeholders, contributing to a positive reputation and competitive advantage. 5. Strategic management enables effective risk management and strategic decision-making, supporting long-term sustainability and growth. Capital adequacy in insurance companies. Capital adequacy in insurance companies entails the sufficiency of a company's capital to meet its obligations and absorb potential losses. This concept is crucial for ensuring an insurance company remains solvent and can fulfill its commitments to policyholders even during adverse conditions. The importance of capital adequacy is rooted in the financial stability and reliability of the insurance sector, which plays a critical role in the broader economy. The regulatory landscape governing capital adequacy has evolved significantly over time. Historically, various financial crises and insurance company failures have highlighted the need for robust capital requirements. For instance, the collapse of several high-profile insurers in the late 20th and early 21st centuries led to increased scrutiny and more sophisticated regulatory frameworks. In response to these challenges, jurisdictions worldwide have implemented rigorous standards to ensure that insurance companies maintain adequate capital. Among these are Solvency II in Europe and the Risk-Based Capital (RBC) system in the United States. These frameworks aim to standardize capital adequacy assessment and enhance the insurance sector's resilience. Importance of capital adequacy in insurance companies. 1. Financial stability and solvency. Capital adequacy is fundamental to insurance companies' solvency. Adequate capital buffers against unexpected losses and financial shocks, thereby reducing insolvency risk. This is crucial for maintaining trust in the insurance sector and protecting policyholders. 2. Policyholder protection. Ensuring that insurance companies have sufficient capital is vital for safeguarding policyholders' interests. In the event of significant claims or adverse market conditions, a well-capitalized insurer can meet its obligations without jeopardizing policyholder benefits. 3. Market confidence. Capital adequacy contributes to overall confidence in the financial markets. Investors, policyholders, and other stakeholders are likelier to engage with insurers that demonstrate strong capital positions. This confidence can translate into increased market share and competitive advantage for well-capitalized companies. 4. Regulatory compliance. Insurance companies are subject to stringent regulatory requirements to ensure capital adequacy. Compliance with these regulations is a legal obligation and a measure of good governance and risk management. Failure to comply can result in penalties, increased scrutiny, and reputational damage. 5. Risk management. Adequate capital allows insurance companies to implement effective risk management strategies. Insurers can better absorb losses from underwriting, market, operational, and other risks by holding sufficient capital. This enables them to offer a broader range of products and services while managing potential exposures. 6. Economic impact. The insurance industry plays a critical economic role by providing risk transfer mechanisms and financial protection. Capital adequacy ensures that insurers can continue to perform these functions even during economic downturns, thereby contributing to economic stability and growth. 7. Global standards and harmonization. Adopting international standards like Solvency II and the RBC framework has facilitated greater harmonization and consistency in capital adequacy assessment. This is particularly important for global insurance companies operating across multiple jurisdictions, as it simplifies compliance and enhances comparability. Capital adequacy is a cornerstone of the insurance industry's financial health and operational stability. It ensures that insurance companies can withstand financial shocks, protect policyholders, and maintain market confidence, all while complying with regulatory standards and contributing to economic stability. The continuous evolution and enhancement of capital adequacy frameworks are essential for addressing emerging risks and maintaining the insurance sector's resilience. Computation of capital adequacy ratios of an insurance company. To calculate an insurance company's capital adequacy ratios, we need to consider various metrics that reflect the company's financial health and ability to meet obligations. The key ratios include the solvency ratio, the combined ratio, and the capital buffer. Let us calculate capital adequacy ratios. 1. Solvency ratio. The solvency ratio measures an insurance company's ability to meet its long-term obligations. It is calculated as the ratio of the company's available capital to its required capital, Solvency Capital Requirement, SCR. The formula of solvency ratio is available capital divided by SCR. Example: available capital $100 million. Solvency Capital Requirement, SCR, $40 million. The calculation of the solvency ratio is 100 divided by 40, which equals 2.5 or 250%. A solvency ratio of 250% means the company has 2.5 times the capital required to cover its risks, indicating robust financial health. 2. Combined ratio. The combined ratio is specific to non-life insurance and measures underwriting profitability. It is the sum of the loss ratio and the expense ratio. The formula of combined ratio is loss ratio plus expense ratio. The loss ratio is calculated by dividing claims incurred with premiums earned multiplied by 100. The expense ratio is calculated by dividing operating expenses with premiums written multiplied by 100. Example data. Claims incurred $60 million. Premiums earned $100 million. Operating expenses, $25 million. And premiums written, $100 million. Calculation. The loss ratio is calculated as 60 divided by 100, multiplied by 100, which equals 60%. The expense ratio is calculated as 25 divided by 100, multiplied by 100, which equals 25%. The combined ratio is calculated as 60% plus 25%, which equals 85%. A combined ratio of 85% indicates that the company is profitable in its underwriting operations, as the ratio is below 100%. 3. Capital buffer. The capital buffer represents the insurance company's excess capital over the regulatory minimum requirement, SCR. The formula for capital buffer is the available capital, less the solvency capital requirement. For example, available capital, $100 million, and solvency capital requirement, SCR, $40 million. The capital buffer is calculated by subtracting $40 million from $100 million, which equals $60 million. A capital buffer of $60 million indicates that the company has a significant cushion above the regulatory requirement, enhancing its financial stability and capacity to absorb unexpected losses. Here is the summary of the calculated ratios. For the solvency ratio: available capital, $100 million. SCR, $40 million. And solvency ratio, 250%. For combined ratio: claims incurred, $60 million. Premiums earned, $100 million. Operating expenses, $25 million. Premiums written, $100 million. And combined ratio, 85%. For capital buffer: available capital, $100 million. SCR, $40 million. And capital buffer, $60 million. These ratios provide a comprehensive view of the insurance company's capital adequacy, underwriting profitability, and financial buffer, indicating its financial health and resilience. Historical evolution of capital adequacy requirements. The discussion on the historical evolution of capital adequacy is divided into two: early and recent developments. Early development. 1. Pre-20th century. In the early stages of the insurance industry, there were few formal capital adequacy requirements. Insurers operated based on mutual trust, and capital reserves were primarily determined by individual company practices and market norms. 2. Early 20th century. 1. Emergence of regulatory oversight. As the insurance industry grew, the need for regulatory oversight became apparent. Early regulations focused on basic solvency requirements and the need for insurers to maintain adequate reserves to cover policyholder claims. 2. Introduction of solvency margins. Some countries introduced solvency margins, requiring insurers to hold capital exceeding their liabilities by a certain percentage. This was a rudimentary form of ensuring insurers had a buffer against unexpected losses. Mid-20th century. 1. Post-World War II expansion. Growth of the insurance industry. The post-war economic boom led to significant growth in the insurance sector. With this growth came increased regulatory scrutiny and the development of more structured capital adequacy requirements. NAIC formation, 1945, the National Association of Insurance Commissioners, NAIC, was established to provide a standard regulatory framework in the United States. The NAIC developed model laws and regulations, including solvency standards for insurers. 2. 1960s–1970s. Introduction of more formalized solvency standards. Countries began to adopt more formalized solvency standards. For instance, the EU introduced the first non-life directive in 1973, establishing minimum solvency margins for non-life insurers. Late 20th century. 1. 1980s. Early risk-based capital, RBC, concepts. In the US, the NAIC began developing the risk-based capital, RBC, framework in response to insurer failures. The RBC framework aimed to align capital requirements more closely with the risk profile of individual insurers. Solvency I Directive, 1979. The Solvency I Directive was implemented in Europe to ensure that insurance companies maintained sufficient capital reserves. It established minimum solvency margins and aimed to protect policyholders by ensuring that insurers had enough capital to meet their obligations. 2. 1990s. Implementation of RBC in the US, 1992. The NAIC adopted the RBC formula, which became a fundamental part of US insurance regulation. The RBC framework required insurers to hold capital proportional to their risk exposure, considering underwriting, asset, credit, and business risks. Basel Accords influence. The Basel I Accord, 1988, and subsequent Basel II Accord, 2004, influenced the development of capital adequacy standards for insurers, particularly regarding the integration of more sophisticated risk assessment and capital allocation models. Early 21st century. 2000s. 1. Introduction of Solvency II, 2009. The EU developed the Solvency II Directive, which represented a significant overhaul of the regulatory framework for insurance companies. Solvency II, implemented in 2016, introduced a risk-based approach to capital adequacy, aligning more closely with the Basel II principles used in banking regulation. Pillar 1, Quantitative Requirements, including T. Solvency Capital Requirement, SCR, and Minimum Capital Requirement, MCR. Pillar 2, Governance and Risk Management Requirements. Pillar 3, Reporting and Disclosure Requirements to enhance market discipline. 2. Increased regulatory scrutiny. The global financial crisis, 2008, necessitated increased regulatory scrutiny. The financial crisis underscored the importance of robust capital adequacy standards. Regulatory bodies worldwide strengthened their focus on ensuring that insurance companies maintain sufficient capital buffers to withstand financial shocks. Recent developments. 1. 2010s present. Ongoing enhancements to Solvency II. The EU continues to refine and enhance the Solvency II framework, incorporating lessons learned from the initial implementation and addressing emerging risks. Introduction of IFRS 17, 2023, the International Financial Reporting Standard, IFRS 17, aims to improve the transparency and comparability of insurers' financial statements. It impacts how insurers report liabilities and reserves, indirectly influencing capital adequacy assessments. Development of the Insurance Capital Standard, ICS. The International Association of Insurance Supervisors, IAIS, has been working on the Insurance Capital Standard, ICS, to create a globally comparable framework for assessing capital adequacy in the insurance sector. 2. Post-pandemic adjustments. Adaptation to COVID-19 impact. The COVID-19 pandemic has led to further scrutiny and adjustments in capital adequacy frameworks to ensure that insurers can handle the increased uncertainty and potential for large-scale claims. The historical evolution of capital adequacy requirements in the insurance industry reflects a trajectory from essential solvency margins to sophisticated, risk-based frameworks. The development has been driven by the growth of the insurance sector, financial crises, and advancements in risk management practices. Modern frameworks like Solvency II and RBC represent comprehensive approaches to ensuring that insurers maintain sufficient capital to cover their risks, protect policyholders, and contribute to financial stability. The ongoing refinement of these frameworks and the introduction of new standards like IFRS 17 and ICS indicate a continued commitment to robust capital adequacy in the face of evolving risks. Insurance regulatory frameworks and standards. Insurance regulatory frameworks and standards are designed to ensure the insurance industry's stability, transparency, and fairness. They protect policyholders, maintain market integrity, and promote financial stability. These frameworks vary by region but share common objectives and principles. Let us briefly highlight some key insurance regulatory frameworks and standards. 1. Solvency II. Solvency II is a comprehensive regulatory framework that governs insurance companies' capital requirements, risk management, and supervisory practices within the European Union. It aims to ensure that insurers have sufficient capital to cover their risks and to enhance policyholder protection. However, Solvency II has also been adopted by several non-European insurance sectors. Solvency II uses a risk-based approach to determine capital requirements, ensuring that insurers hold capital proportional to their risk exposures. The Solvency II consists of the following three pillars. Pillar 1, quantitative requirements, including calculating the solvency capital requirement, SCR, and minimum capital requirement, MCR. Pillar 2, qualitative requirements, focusing on governance, risk management, and supervisory review processes. Pillar 3, disclosure and transparency requirements ensure that insurers provide regulators and the public with accurate and comprehensive information. 2. Risk-based capital. The risk-based capital, RBC, framework is a set of capital requirements for insurance companies in the United States. It ensures that insurers maintain adequate capital relative to their risk profiles, protecting policyholders and promoting financial stability. Several insurance industries outside the United States have also adopted the RBC. Here are the two critical components of the risk-based capital framework. 1. Calculation of RBC. RBC requirements are calculated based on the insurer's asset risk, underwriting risk, credit risk, and operational risk. The framework provides a formulaic approach to determine the minimum capital needed to cover these risks. 2. Action levels. The RBC framework establishes different action levels, each triggering specific regulatory responses, ranging from increased oversight to mandatory corrective actions. 3. International Association of Insurance Supervisors. The International Association of Insurance Supervisors, IAIS, is a global standard-setting body for insurance regulation. It develops and promotes principles, standards, and guidelines for the supervision of the insurance industry worldwide. Here are the two key components of IAIS. 1. Insurance Core Principles, ICPs. The IAIS has established a set of insurance core principles, ICPs, that provide a globally accepted framework for supervising the insurance sector. These principles cover corporate governance, risk management, capital adequacy, and market conduct. 2. Common Framework, COMFRAME. COMFRAME is a comprehensive regulatory framework developed by the IAIS to supervise internationally active insurance groups, IGs. It includes qualitative and quantitative requirements, including the Insurance Capital Standard, ICS. 4. Other international standards and regional regulations. Besides Solvency II, RBC, and IAIS guidelines, other regional and international regulatory frameworks influence insurance regulation. 1. Basel III. While primarily focused on banking, Basel III's principles on risk management and capital adequacy have influenced insurance regulation, particularly for insurers that are part of larger financial conglomerates. 2. Financial Stability Board, FSB. The FSB coordinates at the international level the work of national financial authorities and international standard-setting bodies to develop strong regulatory, supervisory, and other financial sector policies, including for the insurance sector. 3. Regional regulations. Different regions have their specific regulatory frameworks, such as the Prudential Regulation Authority, PRA, in the UK, the Australian Prudential Regulation Authority, APRA, and the Office of the Superintendent of Financial Institutions, OSFI, in Canada. These bodies set regulations and standards tailored to their local markets while aligning with international best practices. Insurance regulatory frameworks and standards are critical in ensuring insurance companies' financial health and stability. By setting comprehensive requirements for capital adequacy, risk management, and transparency, these frameworks protect policyholders, enhance market confidence, and promote the resilience of the insurance sector. Insurers must continuously adapt to evolving regulatory requirements and ensure compliance to maintain competitiveness and sustainability in the global market. Having highlighted regulatory frameworks and standards, let us discuss critical insurance regulatory frameworks and standards, including Solvency II, Risk-Based Capital, RBC, and International Association of Insurance Supervisors, IAIS, guidelines. Solvency II, Regulatory Frameworks and Standards. Solvency II is a comprehensive regulatory framework designed to enhance the prudential regulation of insurance and reinsurance companies in the European Union. Implemented on January 1, 2016, Solvency II aims to ensure insurers' financial stability and resilience by promoting robust risk management practices, improving transparency, and aligning capital requirements with their actual risk profiles. Solvency II is based on a three-pillar structure encompassing quantitative, qualitative, and disclosure requirements. Pillar 1, Quantitative Requirements. Pillar 1 focuses on the quantitative aspects of solvency, establishing the minimum capital requirements and methods for calculating them. 1. Solvency Capital Requirement. Solvency Capital Requirement, SCR, represents the amount of capital an insurer must hold to ensure it can meet its obligations over the next 12 months with a 99.5% confidence level. The SCR can be calculated using a standard formula and internal models. Standard formula. This predefined formula set by regulators considers various risk modules, including market, underwriting, credit, and operational risks. Internal models. Insurers can develop internal models to calculate the SCR, provided these models are approved by regulatory authorities. Internal models are often more tailored to the company's specific risk profile. 2. Minimum Capital Requirement. The minimum capital requirement, MCR, is the lower threshold of capital that insurers must maintain to avoid regulatory intervention. It represents the absolute minimum capital necessary for an insurer to continue operating. The MCR is typically calculated using a more straightforward, conservative approach than the SCR. 3. Technical Provisions. Insurers must hold technical provisions and liabilities set aside to cover future claims. These provisions must be calculated based on best estimates and include a risk margin. Pillar 2, Qualitative Requirements. Pillar 2 addresses the qualitative aspects of regulation, focusing on governance, risk management, and supervisory review processes. 1. Governance and risk management. Insurers must have robust governance structures and effective risk management systems in place. Own Risk and Solvency Assessment, ORSA. Insurers must conduct regular ORSA, an internal risk profile, and capital needs assessment. ORSA helps insurers understand their current and future solvency positions and ensure they hold adequate capital. 2. Supervisory Review Process. Regulators perform a supervisory review to assess the quality of an insurer's governance, risk management, and overall compliance with Solvency II requirements. The review process includes on-site inspections and off-site monitoring, ensuring that insurers adhere to regulatory standards. Pillar 3, Disclosure and Transparency Requirements. Pillar 3 aims to enhance market discipline through increased transparency and disclosure requirements. 1. Public disclosure. Insurers must publish a Solvency and Financial Condition Report, SFCR, annually. The SFCR provides detailed information about the insurer's financial condition, risk profile, governance structure, and solvency position. 2. Regulatory reporting. Insurers must submit a regular supervisory report, RSR, to regulators, which contains more detailed and confidential information than the SFCR. 3. Market discipline. By making comprehensive information publicly available, Solvency II aims to enhance market discipline, allowing stakeholders to make informed decisions based on insurers' financial health and risk management practices. Key components of the Solvency II framework. 1. Solvency Capital Requirement Risk Modules. Risk modules in Solvency Capital Requirement (SCR) calculation include market, underwriting, credit, and operational risks. Market risk includes risks related to changes in market prices, such as interest rate risk, equity risk, property risk, and currency risk. Underwriting risk covers risks associated with the insurer's core business of underwriting policies, including premium risk, reserve risk, and catastrophe risk. Credit risk reflects the risk of counterparties failing to meet their obligations. Operational risk encompasses risks from failed internal processes, people, systems, or external events. 2. Proportionality principle. Solvency II applies the proportionality principle, meaning that the regulatory requirements should be proportional to the insurer's business's nature, scale, and complexity. Smaller insurers or those with less complex risk profiles may face simplified requirements. 3. Group supervision. Solvency II includes provisions for supervising insurance groups, ensuring that risks are managed and capital adequacy is maintained at the group and solo entity levels. Benefits of Solvency II. 1. Enhanced risk management. Solvency II promotes a robust risk management culture, encouraging insurers to understand better and manage their risks. 2. Improved capital allocation. Solvency II helps insurers allocate capital more efficiently by aligning capital requirements with actual risk profiles. 3. Greater transparency. Increased disclosure requirements improve transparency, enabling stakeholders to make better informed decisions. 4. Policyholder protection. The Solvency II stringent capital and governance requirements help ensure that insurers remain solvent and meet their obligations to policyholders, enhancing policyholder protection. Solvency II represents a significant advancement in the regulation of insurance companies, introducing a risk-based approach to capital adequacy, promoting robust governance and risk management practices, and enhancing transparency through comprehensive disclosure requirements. By aligning capital requirements with the actual risk profiles of insurers, Solvency II aims to ensure the financial stability and resilience of the insurance sector, ultimately protecting policyholders and maintaining market confidence. Having explained Solvency II, let us proceed to discuss risk-based capital. Risk-based capital, RBC, regulatory frameworks and standards. Risk-based capital, RBC, is a regulatory framework primarily used in the United States to ensure insurance companies maintain sufficient capital relative to their risk profiles. The RBC framework is designed to protect policyholders and enhance the financial stability of the insurance industry by requiring insurers to hold capital commensurate with the risks they underwrite and their assets. The development and evolution of risk-based capital framework. 1. 1980s, early concepts. The RBC concept emerged in the late 1980s due to several high-profile insurer insolvencies. Regulators recognized the need for a more robust system to assess the adequacy of insurers' capital based on their specific risk exposures. 2. 1990s, implementation. The National Association of Insurance Commissioners, NAIC, developed the RBC framework, formally adopted in 1992 for life insurers and later extended to property and casualty insurers and health insurers. The RBC model introduced a formula-based approach to determine the minimum capital required to support the insurer's overall business operations, reflecting the riskiness of their assets and liabilities. Key components of the RBC framework. 1. RBC formula. the RBC formula calculates the minimum amount of capital an insurer needs based on various risk factors. The formula incorporates different risk components, each reflecting a specific type of risk the insurer faces. 2. Risk categories. Risk-based capital, RBC. Risk categories include asset risk. This includes risks associated with the insurer's investments and other assets, such as market risk, credit risk, and interest rate risk. Underwriting risk. This covers the risk of losses from underwriting activities, including risks related to premium adequacy, claim fluctuations, and reserve sufficiency. Credit risk. This reflects the risk of default by counterparties, including reinsurers, policyholders, and other debtors. Operational risk. This includes risks arising from inadequate or failed internal processes, people, systems, or external events. 3. RBC calculation. The RBC calculation involves applying specific factors to different types of assets, liabilities, and operational components to determine the capital required for each risk category. The formula aggregates the capital requirements for each risk category, adjusting for diversification effects and correlations between different risks. 4. RBC ratio. The RBC ratio is calculated by dividing an insurer's total adjusted capital, TAC, by its authorized control level RBC, ACL/RBC. The risk-based capital, RBC, formula is the total adjusted capital, TAC, divided by the authorized control level RBC, ACL/RBC. 5. Regulatory action levels. The RBC framework establishes specific regulatory intervention thresholds based on the RBC ratio. These thresholds trigger different regulatory action levels, including the company action level, regulatory action level, authorized control level, and mandatory control level, to ensure insurers maintain adequate capital. Company action level, CAL, RBC ratio between 150% and 200%. Insurers must submit a corrective action plan to regulators. Regulatory action level, RAL, RBC ratio between 100% and 150%. Regulators may take additional actions, including examination and issuing orders. Authorized control level, ACL, RBC ratio between 70% and 100%. Regulators have the authority to take control of the insurer. Mandatory control level, MCL, RBC ratio below 70%. Regulators are required to take control of the insurer to protect policyholders. Implementation and impact on insurance companies. 1. Life insurance companies. Life insurers were the first to adopt the RBC framework. The RBC formula for life insurers includes specific components for interest rate risk, insurance risk, and asset risk, reflecting the unique risk profile of life insurance products. 2. Property and casualty insurance companies. The RBC framework for property and casualty insurers incorporates factors for underwriting risk, including premium risk, reserve risk, asset risk, and credit risk. 3. Health insurance companies. Health insurers also use a modified RBC formula that accounts for risks specific to health insurance, such as morbidity and provider contract risks. The benefits of RBC framework. 1. Enhanced risk sensitivity. The RBC framework aligns capital requirements with insurers' actual risk profiles, promoting a more risk-sensitive approach to capital adequacy. 2. Improved regulatory oversight. RBC provides regulators with a standardized method for assessing insurers' financial health, enabling more timely and effective intervention to prevent insolvencies. 3. Policyholder protection. The RBC framework helps protect policyholders from insolvency by ensuring that insurers hold adequate capital to cover their risks. 4. Market discipline. Increased transparency and the potential for regulatory intervention based on RBC ratios encourage insurers to maintain prudent risk management practices. Challenges and criticisms of RBC framework. 1. Complexity and implementation costs. The RBC framework can be complex, particularly for smaller insurers with limited resources. The calculation and reporting requirements can be burdensome. 2. Model limitations. Critics argue that the RBC formula may only partially capture all risks, particularly emerging risks and risks related to complex financial instruments. 3. Procyclicality. The RBC framework may exacerbate procyclical behavior, where insurers are forced to raise capital or reduce risk during economic downturns, potentially further destabilizing the market. Recent developments and future directions of RBC framework. 1. Refinements and updates. The NAIC continues refining the RBC framework, incorporating lessons from past financial crises and advances in risk management practices. Recent updates focus on improving the accuracy and relevance of the risk factors used in the RBC formula. 2. International coordination. While the RBC framework is primarily used in the United States, there is ongoing coordination with international regulatory standards, such as Solvency II in Europe and the Insurance Capital Standard, ICS, developed by the International Association of Insurance Supervisors, IAIS. 3. Emerging risks. Future enhancements to the RBC framework may include better integrating emerging risks, such as cyber risk, climate change risk, and other systemic risks, to ensure that capital requirements remain relevant in a changing risk landscape. The risk-based capital, RBC, framework represents a significant advancement in the regulation of insurance companies, promoting a more risk-sensitive approach to capital adequacy. By aligning capital requirements with the actual risk profiles of insurers, the RBC framework enhances the financial stability of the insurance sector, protects policyholders, and improves regulatory oversight. Despite its challenges and limitations, the RBC framework continues to evolve, incorporating new risks and regulatory best practices to ensure the ongoing resilience of the insurance industry. After explaining risk-based capital, we will discuss the International Association of Insurance Supervisors, IAIS, guidelines. International Association of Insurance Supervisors, IAIS, guidelines. The International Association of Insurance Supervisors, IAIS, provides global standards and guidelines for the supervision of the insurance industry. These guidelines promote financial stability, market integrity, and policyholder protection across jurisdictions. Here are some fundamental guidelines and principles issued by the IAIS. 1. Insurance Core Principles, ICPs. The ICPs are internationally agreed upon principles and standards for regulating and supervising the insurance sector. They cover licensing and supervisory powers, corporate governance, risk management, and solvency assessment. The ICPs serve as a framework for assessing the effectiveness of insurance supervision in individual jurisdictions and promoting consistency and comparability of regulatory practices globally. 2. Common Framework for the Supervision of Internationally Active Insurance Groups, COMFRAME. COMFRAME is a comprehensive framework developed by the IAIS to provide a common set of standards for the supervision of internationally active insurance groups, IGs. COMFRAME addresses vital aspects of IG supervision, including group-wide supervision, capital adequacy, governance, risk management, and group-wide supervision and coordination. 3. Insurance Capital Standard, ICS. The ICS is a global capital standard for internationally active insurance groups, IGs, developed by the IAIS. It aims to provide a harmonized approach to assessing the capital adequacy of IGs across jurisdictions. The ICS is designed to capture the overall risk profile of IGs, including insurance, market, credit, and operational risks, and to promote greater consistency and comparability in capital requirements. 4. Risk-Based Supervision, RBS. IAIS guidelines promote the adoption of risk-based supervision, RBS, frameworks by insurance supervisors worldwide. RBS emphasizes identifying, assessing, and managing risks within insurance companies, focusing on enhancing the effectiveness and efficiency of supervisory processes. 5. Corporate Governance Guidelines. II's guidelines on corporate governance provide principles and recommendations for the effective governance of insurance companies. These guidelines cover board composition and structure, risk management, internal controls, transparency, and disclosure. 6. Supervisory cooperation and coordination. II's guidelines promote cooperation and coordination among insurance supervisors at the national and international levels. This includes principles and standards for information exchange, mutual assistance, and collaboration on cross-border supervision of insurance groups. 7. Market conduct and consumer protection. II's guidelines address market conduct and consumer protection issues in the insurance sector, emphasizing the importance of fair treatment of policyholders, transparency in product offerings, and mechanisms for resolving consumer complaints. 8. Reinsurance supervision. II's guidelines on reinsurance supervision provide principles and standards for effective supervision of reinsurance activities, including assessing reinsurance counterparty risk, collateral requirements, and regulatory reporting. 9. Financial stability and systemic risk. II's guidelines on financial stability and systemic risk address the role of insurance companies in contributing to overall financial stability and the potential systemic risks associated with the insurance sector. These guidelines promote macroprudential supervision and stress testing to assess systemic risk vulnerabilities. 10. Climate risk and sustainability. Recognizing the importance of climate risk and sustainability in the insurance sector, the IIS has issued guidelines and principles to help insurance supervisors and companies assess and manage climate-related risks and promote sustainable insurance practices. These guidelines and principles issued by the IIS provide a comprehensive framework for regulating and supervising the global insurance industry. They promote financial stability, market integrity, and policyholder protection across jurisdictions. They serve as a reference for insurance supervisors and policymakers in developing and implementing effective regulatory frameworks tailored to their specific market conditions and regulatory objectives. Practical application and analysis of capital adequacy. Key metrics and indicators of solvency. Capital adequacy include solvency ratios, capital buffers and surplus, and stress testing results. Using quantitative data and a hypothetical insurance company, let us analyze capital adequacy using key metrics and indicators. We will utilize quantitative data on solvency ratios, capital buffers and surplus, and stress testing results to analyze capital adequacy using key metrics and indicators. Let us consider a hypothetical insurance company, ABC Insurance Company, and examine these metrics over a specific period, such as fiscal year 2023. 1. Solvency ratios. Solvency ratios measure the relationship between an insurer's capital and liabilities, indicating its ability to meet financial obligations. Common solvency ratios include the Solvency Capital Requirement, SCR, and Minimum Capital Requirement, MCR, ratios. Solvency Capital Requirement, SCR, ratio. Formula of SCR ratio equals total available solvency capital, divided by solvency capital requirement. Interpretation: a ratio above 100% indicates that the insurer holds sufficient capital to cover its risks. Minimum capital requirement, MCR, ratio. Formula of MCR ratio equals total available solvency capital, divided by minimum capital requirement. Interpretation: a ratio above 100% indicates compliance with regulatory capital requirements. 2. Capital buffers and surplus. Capital buffers and surplus represent the excess of available capital over regulatory requirements, providing a cushion against unexpected losses and ensuring financial stability. This entails computing capital surplus and capital buffer ratio. Capital surplus. Calculation: capital surplus equals total available solvency capital, less solvency capital requirement. Interpretation: a positive surplus indicates that the insurer has additional capital beyond regulatory requirements. Capital buffer ratio. Formula: capital buffer ratio equals total available solvency capital, less solvency capital requirement, divided by solvency capital requirement. Interpretation: a ratio above 0 indicates the magnitude of the capital buffer relative to the SCR. 3. Stress testing results. Stress testing assesses an insurer's resilience to adverse scenarios by simulating extreme events or economic downturns. Stress test scenarios. Examples of stress testing scenarios include economic recession, catastrophic events, and significant market downturns. Stress test outcomes: measures impact on capital position, solvency ratios, and ability to withstand shocks. Interpretation: insurers with robust capital adequacy should demonstrate resilience and maintain solvency ratios above regulatory thresholds even under stress. Now, let us conduct a capital adequacy analysis using quantitative data. Assuming the following quantitative data for ABC Insurance Company for the fiscal year 2023. Total available solvency capital, $100 million. Solvency capital requirement, $80 million. Minimum capital requirement, $60 million. Calculation of solvency ratios. SCR ratio equals $100 million, divided by $80 million equals 125%. MCR ratio equals $100 million, divided by $60 million equals 167%. Calculation of capital buffers and surplus. Capital surplus equals $100 million, less $80 million equals $20 million. Capital buffer ratio equals $100 million, less $80 million, divided by $80 million equals 25%. The stress testing results. ABC Insurance Company conducted stress tests simulating extreme scenarios, including a severe economic recession and catastrophic natural disasters. The results indicated that despite extreme stress, the company maintained solvency ratios well above regulatory thresholds, demonstrating resilience and robust capital adequacy. Based on the analysis of solvency ratios, capital buffers, and stress testing results, ABC Insurance Company appears to have a strong capital adequacy position in the fiscal year 2023. The company maintains adequate capital reserves to cover its risks, exceeds regulatory capital requirements, and demonstrates resilience to adverse scenarios. This analysis gives stakeholders confidence in the insurer's financial stability and ability to protect policyholders' interests. Impact of regulatory changes on capital adequacy. Regulatory changes have significant implications for capital adequacy in the insurance industry. The impact of regulatory changes on capital adequacy in the insurance industry can be profound, influencing insurers' capital positions, risk management practices, and overall financial stability. Regulatory changes may stem from updates to existing frameworks, the introduction of new regulations, or amendments to international standards. These changes can affect how insurers assess their capital needs, manage risks, and comply with regulatory standards. Here are some of the ways regulatory changes impact on capital adequacy. 1. Enhanced capital requirements. Increased capital buffers. Regulatory changes often involve raising minimum capital requirements. Insurers must maintain larger capital buffers to cover potential losses, leading to enhanced solvency and reduced risk of insolvency. Solvency margins. Stricter solvency margins ensure that insurers have sufficient capital to meet policyholder claims even during adverse economic conditions. 2. Risk-based capital, RBC, and Solvency II. Risk-based capital, RBC. Tailored capital requirements. RBC frameworks adjust capital requirements based on each insurer's risk profile. This ensures that capital adequacy is aligned with the company's actual risk exposure. Dynamic adjustments. RBC allows for dynamic adjustments to capital requirements as the risk profile of the insurer changes, promoting ongoing financial stability. Solvency II. Three-pillar approach. Solvency II's three-pillar approach, quantitative requirements, qualitative requirements, and disclosure, provides a comprehensive framework for managing capital adequacy. Economic capital models. Solvency II encourages the use of economic capital models that reflect insurers' actual risk exposure and capital needs, leading to more accurate and effective capital management. 3. Enhanced risk management practices. Enterprise risk management, ERM, regulatory changes often mandate sound ERM practices. Insurers must adopt robust risk management frameworks to comprehensively identify, assess, and mitigate risks. Stress testing and scenario analysis. Regulators may require more frequent and rigorous stress testing and scenario analysis. These practices help insurers assess their resilience to adverse conditions and maintain adequate capital buffers. 4. Regulatory reporting and transparency. Increased disclosure requirements. Enhanced regulatory reporting and disclosure requirements improve transparency regarding insurers' capital adequacy and risk exposures. This builds market confidence and allows stakeholders to make informed decisions. Supervisory oversight. Regular reporting and increased transparency enable more effective supervisory oversight, ensuring that insurers maintain compliance with capital adequacy standards. 5. Technological advancements. RegTech solutions. Regulatory technology. RegTech solutions facilitate compliance with evolving regulatory requirements. Insurers can use technology to automate regulatory reporting, monitor risk exposures, and manage capital adequacy more efficiently. Data analytics. Advanced data analytics and machine learning techniques allow insurers to better understand and manage their risk profiles, leading to more accurate capital adequacy assessments. 6. Global harmonization and regulatory convergence. Consistent standards. Efforts to harmonize regulatory standards globally, such as the Insurance Capital Standard, ICS, developed by the International Association of Insurance Supervisors, IAIS, ensure consistent capital adequacy requirements across jurisdictions. Cross-border supervision. Regulatory convergence facilitates more effective cross-border supervision and cooperation, enhancing the stability of globally active insurance groups. 7. Economic and market conditions. Responsive regulation. Regulatory changes are often made in response to evolving economic and market conditions. For example, the aftermath of financial crises typically leads to stricter capital adequacy regulations to prevent future systemic risks. Adaptation to market changes. Insurers must adapt to regulatory changes that address new market developments, such as emerging risks, for example, cyber risk, climate change risk, and technological advancements, for example, digital transformation. Regulatory changes significantly impact capital adequacy in the insurance industry by setting higher standards, promoting robust risk management practices, and enhancing transparency and supervisory oversight. Insurers must continuously adapt to these changes to maintain financial stability, comply with regulatory requirements, and protect policyholders. Embracing technological advancements and global regulatory convergence will further strengthen insurers' ability to manage capital adequacy effectively in an evolving regulatory landscape. Capital adequacy challenges and issues. Capital adequacy is a cornerstone of financial stability in the insurance industry, but it is not without its challenges and issues. Here are some common challenges and issues related to capital adequacy faced by insurers. 1. Regulatory compliance burden. Complexity of regulatory requirements. Regulatory frameworks such as Solvency II or local regulatory regimes can be complex and demanding. Compliance requires extensive reporting, risk modeling, and governance structures, placing a significant administrative burden on insurers. Cost of compliance. Meeting regulatory requirements entails substantial costs, including investments in technology, risk management systems, and staff training. Smaller insurers may struggle to bear these costs, potentially leading to market consolidation or competitive disadvantages. 2. Volatility and uncertainty. Market volatility, fluctuations in financial markets, interest rates, and asset prices can impact insurers' capital positions. Market volatility can erode capital reserves or necessitate adjustments to risk management strategies, affecting insurers' ability to maintain adequate capital adequacy levels. Economic uncertainty. Economic downturns, geopolitical events, or natural disasters can introduce uncertainty into insurers' risk profiles. Uncertain economic conditions may affect insurers' underwriting profitability, investment returns, and overall financial health, challenging their capital adequacy. 3. Low interest rate environment. Low investment yields. Persistently low interest rates reduce insurers' investment income, particularly for long-term liabilities such as life insurance. Lower investment returns constrain insurers' ability to generate capital internally, putting pressure on capital adequacy ratios. Interest rate risk. Low interest rates increase insurers' risk exposure, particularly if liabilities are long-dated or guaranteed. Insurers may need to allocate additional capital to cover potential losses from adverse interest rate movements. 4. Emerging risks. Cyber risk. Cyber threats pose a growing risk to insurers' operations and financial stability. Cyber attacks can disrupt business operations, compromise sensitive data, and lead to financial losses, necessitating investments in cybersecurity measures and capital reserves to mitigate risks. Climate change risk. Climate change-related events, such as natural disasters and extreme weather events, can result in significant insured losses. Insurers may face challenges in accurately assessing and pricing climate-related risks, requiring adjustments to capital adequacy models and risk management strategies. 5. Business model challenges. Legacy liabilities. Insurers with legacy liabilities, such as long-term annuities or closed business books, may face challenges in managing capital adequacy. Legacy liabilities may require additional capital reserves or risk transfer mechanisms to address potential solvency concerns. New business models. Insurtech startups and digital disruptors are introducing new business models and distribution channels to the insurance industry. Traditional insurers may need to adapt their capital adequacy frameworks to accommodate evolving risk profiles and regulatory requirements associated with these new business models. 6. Global regulatory divergence. Fragmentation of regulatory standards. Regulatory divergence across jurisdictions can create compliance challenges for multinational insurers. Varying capital requirements, reporting standards, and supervisory practices complicate capital management and risk assessment, requiring insurers to navigate a complex regulatory landscape. Jurisdictional arbitrage. Differences in regulatory regimes may incentivize insurers to engage in regulatory arbitrage, such as redomiciling or restructuring operations to jurisdictions with more favorable capital requirements. This can undermine the effectiveness of global regulatory frameworks and lead to regulatory gaps or inconsistencies. Capital adequacy challenges and issues confront insurers with a dynamic and evolving risk landscape. Addressing these challenges requires a proactive approach to risk management, investment strategies, regulatory compliance, and business model adaptation. Insurers must continuously monitor and assess their capital adequacy positions, anticipate emerging risks, and collaborate with regulators and industry stakeholders to promote financial stability and resilience in the face of evolving challenges. Identifying and measuring insurance companies' underwriting, market, and operational risks. Identifying and measuring insurance companies' underwriting, market, and operational risks is essential for assessing their overall risk profile and ensuring adequate capital adequacy. Here's how each of these risks can be identified and measured. 1. Underwriting risk. Underwriting risk refers to loss resulting from inadequate insurance policy pricing or adverse fluctuations in claims experience. It encompasses various risk subcategories, including pricing, reserving, and concentration risks. Identifying underwriting risk. 1. Claims experience analysis. Analyze historical claims data to identify trends, patterns, and anomalies in claims frequency and severity. 2. Underwriting guidelines review. Evaluate the insurer's underwriting guidelines and practices to identify potential areas of underpricing or exposure to high-risk segments. 3. Risk selection process. Assess the insurer's risk selection criteria and underwriting controls to ensure alignment with risk appetite and profitability targets. Measuring underwriting risk. 1. Loss ratio analysis. Calculate the loss ratio, claims incurred divided by premiums earned, to assess the adequacy of pricing and underwriting profitability adequacy. 2. Reserving adequacy. Undertake reserve reviews and loss development analysis to measure reserve adequacy and identify potential deficiencies. 3. Risk concentration analysis. Evaluate the concentration of risk by geographic region, product line, or customer segment to identify diversification opportunities and mitigate concentration risk. 2. Market risk. Market risk refers to the risk of loss resulting from adverse movements in financial markets, including equity prices, interest rates, currency exchange rates, and commodity prices. It encompasses various types of risk, such as equity risk, interest rate risk, credit risk, and currency risk. Identifying market risk. 1. Asset portfolio analysis. Assess the composition and characteristics of the insurer's investment portfolio, including asset allocation, credit quality, and duration. 2. Sensitivity analysis. Conduct sensitivity analysis to quantify the impact of changes in market factors, for example, interest rates, equity prices, on the insurer's financial position. 3. Stress testing. Perform stress tests to simulate extreme market scenarios and assess the resilience of the insurer's capital position under adverse market conditions. Measuring market risk. 1. Value at risk, VAR. Calculating VAR is essential to estimate the potential loss in the insurer's investment portfolio over a specified time horizon at a given confidence level. 2. Duration and convexity analysis. This helps to measure the duration and convexity of the insurer's investment portfolio to assess interest rate sensitivity and exposure to changes in yield curves. 3. Credit risk analysis. Evaluate credit spreads, credit ratings, and credit default probabilities to assess the insurer's investment portfolio's credit risk exposure. 3. Operational risk. Operational risk refers to the risk of loss resulting from inadequate or failed internal processes, systems, people, or external events. It encompasses various types of risk, including internal fraud, external fraud, legal and regulatory compliance, and business continuity. Identifying operational risk. 1. Risk event analysis. Identify past operational incidents, errors, or failures to understand root causes and identify areas of vulnerability. 2. Process mapping. This involves mapping key business processes and identifying control points, dependencies, and potential points of failure. 3. Scenario analysis. Conduct scenario analysis to assess the potential impact of operational disruptions, cyber attacks, or other adverse events on the insurer's operations. Measuring operational risk. 1. Key risk indicators, KRIs. Monitor and measure key risk indicators related to operational processes, such as error rates, transaction processing times, and compliance violations. 2. Loss data analysis. Analyze historical loss data to quantify the frequency and severity of operational losses and estimate potential future losses. 3. Risk control self-assessment, RCSA. Conduct risk control self-assessment exercises to evaluate internal controls' effectiveness and identify areas for improvement. Identifying and measuring underwriting, market, and operational risks are essential to insurance companies' comprehensive risk management framework. By understanding and quantifying these risks, insurers can assess their overall risk exposure, allocate capital effectively, and implement appropriate risk mitigation strategies to enhance their financial stability and resilience. Monitoring and reviewing these risks is critical to ensure that insurers maintain adequate capital adequacy and protect policyholders' interests in an ever-changing risk environment. Meanwhile, regulatory arbitrage and compliance costs are essential to ensuring insurance companies' capital adequacy. Let us discuss their interplay. Regulatory arbitrage and compliance costs. Regulatory arbitrage and compliance costs are intertwined concepts that significantly influence the behavior of financial institutions, including insurance companies, in response to regulatory requirements and incentives. Regulatory arbitrage. Regulatory arbitrage involves exploiting regulatory differences or inconsistencies across jurisdictions to gain a competitive advantage or reduce regulatory costs. In the context of insurance, regulatory arbitrage may involve 1. Jurisdictional choice. Insurers may domicile their operations in jurisdictions with more favorable regulatory regimes, such as lower capital requirements, less stringent oversight, or favorable tax treatment. This allows insurers to minimize compliance costs and regulatory burdens while maximizing profitability. 2. Structural optimization. Insurers may restructure their operations or business models to exploit regulatory loopholes or exemptions. For example, insurers may create complex corporate structures, establish captive insurance entities, or engage in off-balance sheet transactions to optimize capital efficiency and reduce regulatory capital requirements. 3. Product innovation. Insurers may develop innovative insurance products or financial instruments that exploit regulatory arbitrage opportunities. For instance, insurers may create hybrid products that straddle multiple regulatory categories or jurisdictions to optimize risk transfer, capital treatment, or tax efficiency. Compliance costs. Compliance costs refer to the expenses incurred by financial institutions to comply with regulatory requirements. These include direct costs, such as regulatory fees, compliance staff salaries, and technology investments, and indirect costs, such as opportunity costs, regulatory capital charges, and reputational risks. 1. Administrative burden. Regulatory compliance often entails extensive administrative and reporting requirements, such as filing regulatory reports, maintaining compliance documentation, and responding to regulatory inquiries. These administrative burdens can consume significant time and resources, diverting attention from core business activities. 2. Technology investments. Insurers must invest in technology infrastructure, data management systems, and compliance tools to meet our regulatory reporting, monitoring, and risk management requirements. These technology investments can be substantial, particularly for smaller insurers with limited IT budgets and resources. 3. Staffing and training. Insurers must recruit and retain skilled compliance professionals with expertise in regulatory requirements, risk management practices, and industry standards. Investing in staff training and development is essential to ensure compliance with evolving regulatory frameworks and maintain a culture of compliance within the organization. The interplay between regulatory arbitrage and compliance costs. 1. Trade-offs. Insurers may use regulatory arbitrage strategies to minimize compliance costs or constraints. However, regulatory arbitrage may entail additional risks, such as reputational damage, legal and regulatory scrutiny, and adverse market reactions, which could outweigh cost savings benefits. 2. Regulatory response. Regulators may respond to regulatory arbitrage activities by closing loopholes, harmonizing regulatory standards, or imposing stricter oversight and enforcement measures. These regulatory responses may increase compliance costs and reduce the effectiveness of regulatory arbitrage strategies over time. 3. Balancing act. Insurers must balance regulatory compliance, risk management, and business objectives. While regulatory arbitrage may offer short-term advantages regarding cost savings or competitive positioning, insurers must assess the long-term implications and risks associated with regulatory arbitrage activities to maintain financial stability and regulatory compliance. Regulatory arbitrage and compliance costs are complex and interrelated factors influencing insurers' behavior, risk management practices, and financial performance. Insurers must navigate regulatory requirements and market dynamics carefully, balancing the need for compliance with regulatory objectives, business objectives, and shareholder interests. Effective risk management, regulatory engagement, and strategic decision-making are essential to addressing regulatory arbitrage challenges and managing compliance costs effectively in the insurance industry's dynamic and evolving regulatory landscape. Evolving regulatory landscape. The insurance industry's regulatory landscape continually evolves in response to changing market dynamics, emerging risks, technological advancements, and regulatory priorities. Here are some of the key trends that are shaping the changing regulatory landscape for insurance companies. 1. Move towards risk-based supervision. Regulators are increasingly adopting risk-based regulatory frameworks that assess insurers' risk profiles, capital adequacy, and governance structures in a more granular and nuanced manner. This shift enables regulators to tailor regulatory requirements and supervisory interventions based on insurers' risk profiles and systemic importance. 2. Focus on enterprise risk management, (ERM). Regulators emphasize the importance of effective enterprise risk management practices, including risk identification, assessment, mitigation, and monitoring, to ensure that insurers proactively manage and mitigate risks across all operations. 3. Solvency II implementation. Solvency II, a comprehensive regulatory framework introduced in Europe, has set new standards for solvency assessment, capital adequacy, risk management, and insurance reporting requirements. The framework emphasizes principles-based regulation, economic capital modeling, and risk-based supervision to enhance financial stability and policyholder protection. 4. Global regulatory convergence. There is a growing trend towards global regulatory convergence, with regulators aligning capital standards, risk metrics, and supervisory practices across jurisdictions to promote consistency, comparability, and effectiveness in insurance regulation. 5. Focus on emerging risks. Regulators are increasingly focused on emerging risks such as cyber risk, climate change risk, geopolitical risk, and pandemic risk, which pose significant challenges to insurers' risk management practices, capital adequacy, and financial stability. 6. Supervisory stress testing. Regulators conduct stress and scenario analyses to assess insurers' resilience to adverse events, economic downturns, and catastrophic losses. Stress testing helps identify vulnerabilities, quantify capital needs, and inform regulatory actions to mitigate systemic risks and protect policyholders. 7. Regulatory sandboxes and insurtech oversight. Regulators are establishing regulatory sandboxes and innovation hubs to facilitate experimentation, collaboration, and regulatory dialogue with insurance technology, insurtech, startups and technology-driven innovation in the insurance industry. Regulators seek to balance innovation with consumer protection, data privacy, and regulatory compliance. 8. Data governance and cybersecurity. Regulators are enhancing oversight of insurers' data governance practices, cybersecurity measures, and data privacy compliance to address growing cyber threats, data breaches, and privacy concerns associated with the increasing digitization of insurance operations and customer interactions. 9. Enhanced consumer protection. Regulators are strengthening consumer protection measures, disclosure requirements, and market conduct standards to ensure that insurers treat customers fairly, transparently, and ethically. Regulatory oversight prevents mis-selling, unfair practices, and consumer harm in insurance markets. 10. Regulatory reporting and disclosure. Regulators require insurers to provide comprehensive and transparent reporting on their financial condition, risk exposures, and regulatory compliance to enhance market transparency, investor confidence, and regulatory accountability. The evolving regulatory landscape for insurance companies is characterized by a shift towards risk-based regulation, solvency and capital standards, emerging risk management, technology and innovation oversight, consumer protection, and market conduct supervision. Insurers must adapt to these regulatory changes by enhancing their risk management capabilities, capital management practices, compliance frameworks, and operational resilience to thrive in a dynamic and evolving regulatory environment while ensuring continued focus on policyholder protection and financial stability. Regulatory engagement, collaboration, and proactive dialogue between insurers and regulators are essential to foster regulatory compliance, market integrity, and sustainable growth in the insurance industry. Capital adequacy requirements differ across regions and sectors, reflecting each context's unique risks and regulatory philosophies. Let's compare capital adequacy globally. Comparison of capital adequacy across regions. Capital adequacy requirements and insurance company standards vary significantly across regions. These differences are influenced by local regulatory frameworks, market conditions, and the specific risks associated with various types of insurance. Examining approaches to capital adequacy across regions and insurance sectors is beneficial. Regional differences in capital adequacy. 1. Europe, Solvency II framework. Regulatory framework, Solvency II, implemented in 2016, is a comprehensive regulatory framework emphasizing risk-based capital requirements. It consists of 3 pillars: quantitative requirements, governance and risk management, and disclosure and transparency. Capital requirements. Solvency II requires insurers to hold sufficient capital to cover the Solvency Capital Requirement, SCR, which reflects the economic capital needed to ensure a 99.5% probability of solvency over the next year. Risk sensitivity. Solvency II is highly risk sensitive, considering a wide range of risks, including market, credit, operational, and underwriting risks. Solvency II has been discussed in detail earlier in this video. 2. United States, Risk-Based Capital, RBC. Regulatory framework. The National Association of Insurance Commissioners, NAIC, established the RBC standards, which are less prescriptive than Solvency II but risk-sensitive. Capital requirements. Insurers must hold capital based on the risks they face, including assets, insurance, interest rates, and business risks. Action levels. The RBC system includes various action levels that trigger regulatory intervention if an insurer's capital falls below certain thresholds. Earlier in this video, we discussed the risk-based capital, RBC, framework. 3. Canada. Regulator, Office of the Superintendent of Financial Institutions, OSFI. OSFI is the federal agency responsible for regulating and supervising insurance companies in Canada. Its mandate includes ensuring the financial soundness and stability of insurance companies and protecting the interests of policyholders. Framework, Minimum Continuing Capital and Surplus Requirements, MCCSR, and Life Insurance Capital Adequacy Test, LICAT. Canada uses 2 main frameworks to regulate insurance companies' capital adequacy. The MCCSR is primarily used for life insurance companies, while the LICAT is a newer, more comprehensive risk-based framework designed to reflect better the risks life insurers face. Capital requirements, property and casualty, P&C, insurers in Canada are subject to the MCT, which requires insurers to maintain a minimum level of capital based on a percentage of their risk-weighted assets. The LICAT framework requires life insurers to maintain a total ratio of at least 90% and a core ratio of at least 55%, with higher target levels set by OSFI. These ratios are calculated based on the insurer's available and required capital, reflecting their risk profile. Risk categories. Both the MCT and LICAT frameworks are risk-sensitive and consider various risk categories, including credit risk, the risk of loss due to a counterparty's default. Market risk, the risk of loss from adverse movements in market prices, interest, and exchange rates. Insurance risk, the risk of loss from underwriting activities, such as higher than expected claims. Operational risk, the risk of loss from inadequate or failed internal processes, people, systems, or external events. Recent developments. LICAT was introduced in 2018. LICAT is designed to be more risk-sensitive than the previous MCCSR framework. It provides a more granular assessment of an insurer's risk profile, aligning with international best practices and promoting the stability of the insurance sector. OSFI regularly updates its regulatory frameworks to reflect changes in the financial environment, emerging risks, and evolving international standards. This includes periodic adjustments to capital requirements and risk assessments to ensure the robustness and effectiveness of the frameworks. 4. Asia. Here are the highlights of capital adequacy in Japan, China, India, and Singapore. Japan. Regulatory framework. The Financial Services Agency, FSA, oversees Japan's insurance sector. The solvency margin ratio is the primary measure to assess insurers' capital adequacy. Solvency margin ratio. This ratio compares an insurer's available capital to the minimum required capital. It ensures that insurers can absorb significant losses from underwriting and investment activities. Risk sensitivity. The solvency margin ratio includes components for insurance risk, investment risk, and operational risk, making it a relatively risk-sensitive measure. Recent developments. Japan is moving towards incorporating elements of Solvency II to enhance its capital adequacy framework's robustness and risk sensitivity. China. Regulatory framework. The China Risk-Oriented Solvency System, C-ROSS, is the regulatory standard implemented by the China Banking and Insurance Regulatory Commission, CBIRC. C-ROSS structure. Similar to Solvency II, C-ROSS is divided into 3 pillars. Pillar I, quantitative requirements, focusing on market risk, credit risk, and insurance risk. Pillar II, qualitative requirements, including governance and risk management standards. Pillar 3, disclosure and transparency requirements. Risk sensitivity. C-ROSS incorporates detailed risk assessments and capital charges for various types of risk, aiming to align closely with international best practices. Recent developments. The CBIRC continues to refine C-ROSS, with an increasing emphasis on integrating global standards and improving risk management practices. India. Regulatory framework. The Insurance Regulatory and Development Authority of India, IRDAI, sets capital adequacy requirements, primarily using a solvency margin approach. Solvency margin requirements. Insurers are required to maintain a minimum solvency ratio of 150%, calculated as the ratio of the available solvency margin to the required solvency margin. Risk sensitivity. The approach is less sophisticated than Solvency II, focusing mainly on ensuring insurers have a buffer to absorb losses but needing detailed risk-based capital assessments. Recent developments. The IRDAI is considering adopting more risk-based elements to enhance the robustness of the solvency framework. Singapore. Regulatory framework. The Monetary Authority of Singapore, MAS, implements the Risk-Based Capital Framework, RBC2. RBC2 structure. RBC2, similar to Solvency II, incorporates detailed risk assessments across multiple risk categories, including market, credit, operational, and insurance risks. Risk sensitivity. RBC2 is highly risk sensitive, requiring insurers to hold capital commensurate with their risk profiles. Recent developments. MAS continuously updates the RBC framework to ensure alignment with international standards and to address emerging risks. 5. Africa. Here are the highlights of capital adequacy in South Africa, Nigeria, Ghana, Kenya, and Morocco. South Africa. Regulatory framework. The Prudential Authority, PA, oversees the insurance sector and implements the Solvency Assessment and Management, SAM, framework. SAM structure. SAM is closely aligned with Solvency II, incorporating quantitative, qualitative, and disclosure requirements. Pillar I, quantitative requirements, including the calculation of the SCR and MCR. Pillar II, governance and risk management standards. Pillar 3, reporting and public disclosure requirements. Risk sensitivity. SAM is highly risk sensitive, requiring detailed risk assessments and capital charges. Recent developments. Continuous enhancements to SAM ensure alignment with global standards and address emerging risks. B. Nigeria. Regulator. The National Insurance Commission, NICOM, is the regulatory body responsible for supervising and regulating the insurance sector in Nigeria. Risk-based solvency framework. Nigeria is transitioning to a more risk-based solvency framework to ensure insurers maintain adequate capital to cover their risks. NICOM's framework is evolving to incorporate detailed assessments of various risk categories, ensuring that insurers hold capital commensurate with their risk exposures. Minimum capital requirement. NICOM mandates minimum capital levels for different types of insurers to ensure they have a basic buffer to absorb losses. Solvency capital requirement, SCR. The evolving risk-based approach requires insurers to calculate their SCR based on their specific risk profiles, including underwriting, market, credit, and operational risks. Recent developments. NICOM is implementing reforms to enhance the solvency framework's robustness and risk sensitivity, aiming for greater alignment with international best practices. See Ghana. Regulator. The National Insurance Commission, NIC, regulates and supervises the insurance sector in Ghana. Risk-based solvency framework. Ghana is adopting a more comprehensive, risk-based solvency framework to ensure insurers maintain adequate capital. Minimum capital requirement. The NIC mandates minimum capital levels for insurers to ensure a basic buffer to absorb losses. Solvency capital requirement, SCR. The evolving framework requires insurers to calculate their SCR based on their specific risk profiles, incorporating underwriting, market, credit, and operational risks. Recent developments. The NIC is implementing reforms to enhance the robustness and risk sensitivity of the solvency framework, aiming for greater alignment with international best practices. D. Kenya. Regulator. The Insurance Regulatory Authority, IRA, regulates and supervises the insurance industry in Kenya. Risk-based solvency framework. The IRA has implemented a risk-based solvency framework to ensure insurers maintain adequate capital to cover their risks. The framework incorporates risk-based elements, though less comprehensive than Solvency II. Capital requirements. Insurers are required to maintain a minimum level of capital to operate, ensuring a basic buffer to absorb losses. The solvency capital requirement, SCR, is calculated based on the insurer's risk profile, including underwriting, market, credit, and operational risks, ensuring a more risk-sensitive approach to capital adequacy. Recent developments. Insurers are required to maintain a minimum level of capital to operate and ensure a basic buffer to absorb losses. The IRA continues to refine its solvency framework to improve risk sensitivity and regulatory oversight. Morocco. Regulator, Autorité de Contrôle des Assurances et de la Prévoyance Sociale, ACAPS. ACAPS regulates the insurance sector in Morocco. Risk-based solvency framework. ACAPS has implemented a risk-based solvency framework to ensure insurers hold sufficient capital to cover their risk exposures. ACAPS framework includes detailed assessments of various risk categories, ensuring that insurers hold capital commensurate with their risk exposures. Minimum capital requirement. Insurers are required to maintain a minimum level of capital to ensure they have a basic buffer to absorb losses. Solvency capital requirement, SCR. The SCR is calculated based on the insurer's risk profile, including underwriting, market, credit, and operational risks. Recent developments. Framework enhancements. ACAPS continuously updates its regulatory framework to enhance risk sensitivity and improve regulatory oversight, aligning with international standards. 6. Middle East. Here are the highlights of capital adequacy in Saudi Arabia, United Arab Emirates, UAE, Qatar, Bahrain, Kuwait, Oman, and Jordan. Saudi Arabia. Regulatory framework. The Saudi Arabian Monetary Authority, SAMA, oversees the insurance sector and implements a risk-based solvency regime. SAMA's regulatory framework aims to ensure the financial stability and soundness of insurers operating within the country. Solvency requirements. Insurers must maintain sufficient capital to cover their underwriting, investment, and operational risks. Risk sensitivity. SAMA's approach incorporates risk-based elements, though less prescriptive than Solvency II. Recent developments. Efforts are ongoing to enhance risk sensitivity and align with international best practices. United Arab Emirates, UAE. Regulatory framework. The UAE Insurance Authority, IA, mandates capital adequacy requirements through a risk-based solvency framework. Solvency requirements. Insurers must maintain a minimum capital of 100 million Emirati dirhams and adhere to solvency requirements considering various risk factors. Risk sensitivity. The framework includes risk-based capital charges for market, credit, operational, and underwriting risks. Recent developments. The IA is refining its framework to improve risk sensitivity and regulatory oversight. Recent initiatives include improving the insurance industry's governance and risk management standards and adopting more advanced risk assessment tools. See Qatar. Regulator. Qatar Central Bank, QCB, regulates the insurance sector in Qatar, implementing capital adequacy requirements. Framework. The QCB has introduced a risk-based solvency framework aligned with international standards, emphasizing the importance of maintaining sufficient capital to cover various risks. Capital requirements. Insurers are required to maintain a minimum capital base and adhere to solvency requirements that reflect their risk exposure. Risk sensitivity. The framework includes components for market, credit, operational, and insurance risks, similar to Solvency II principles. Recent developments. The QCB continues refining its solvency framework, enhancing risk sensitivity and regulatory oversight to align more closely with international best practices. Bahrain. Regulator. The Central Bank of Bahrain, CBB, oversees the insurance sector and implements a comprehensive regulatory framework that includes capital adequacy requirements. Framework. The CBB's framework is risk-based, similar to Solvency II, and includes detailed requirements for governance, risk management, and disclosure. Capital requirements. Insurers must maintain a minimum capital base and adhere to risk-based solvency requirements. The CBB's framework considers various risk categories: market, credit, operational, and insurance. Risk sensitivity. The framework is designed to be highly risk sensitive, requiring insurers to hold capital commensurate with their risk profiles. Recent developments: the CBB continuously updates its regulatory framework to ensure alignment with international standards and to address emerging risks. Kuwait. Regulator: the Insurance Regulatory Unit, IRU, under the Ministry of Commerce and Industry, regulates the insurance sector in Kuwait. Framework: Kuwait's regulatory framework is evolving, with efforts to implement more comprehensive and risk-sensitive capital adequacy requirements. Capital requirements: insurers are required to maintain minimum capital levels that reflect their risk exposure. The framework is moving towards a more risk-based approach. Risk sensitivity: currently less sophisticated than Solvency II, the framework is being enhanced to include more detailed risk assessments and capital charges. Recent developments: the IRU is working on regulatory reforms to improve the robustness and risk sensitivity of the solvency framework, aiming for greater alignment with international best practices. Oman. Regulator: the Capital Market Authority, CMA, oversees the insurance sector in Oman and implements capital adequacy requirements. Framework: the CMA's framework is risk-based and includes requirements for governance, risk management, and capital adequacy. Capital requirements: insurers must maintain a minimum capital base and adhere to solvency requirements considering various risk factors. Risk sensitivity: the framework is designed to be risk sensitive, incorporating assessments of market, credit, operational, and insurance risks. Recent developments: the CMA is continuously refining its solvency framework to enhance risk sensitivity and ensure alignment with international standards. Jordan. Regulator: the Insurance Directorate within the Ministry of Industry, Trade and Supply regulates the insurance sector in Jordan. Framework: Jordan's regulatory framework includes capital adequacy requirements evolving towards greater risk sensitivity. Capital requirements: insurers are required to maintain minimum capital levels that reflect their risk exposure. The framework is being enhanced to incorporate more risk-based elements. Risk sensitivity: the current framework needs to be more sophisticated but is evolving to include more detailed risk assessments and capital charges. Recent developments: the Insurance Directorate is working on regulatory reforms to improve the robustness and risk sensitivity of the solvency framework, aiming for greater alignment with international best practices. Sectoral and portfolio differences in capital adequacy. Capital adequacy requirements vary significantly across insurance sectors, reflecting different regulatory philosophies and risk profiles. While the principles of maintaining sufficient capital to ensure solvency and policyholder protection are universal, the specific implementation and emphasis on various risks can differ substantially. 1. Life insurance. Risk profile: life insurers face long-term liabilities related to life policies, annuities, and pensions. These products require managing risks such as longevity, mortality, investment risk, and policyholder behavior risk. Capital requirements: life insurers typically have higher capital requirements due to matching long-duration liabilities with appropriate assets and maintaining stability over extended periods. Solvency II, for example, imposes stringent capital requirements on life insurers to meet policyholders' future obligations. 2. Non-life, property and casualty, insurance. Risk profile: non-life insurers deal with shorter-term liabilities but are significantly exposed to catastrophic events, for example, natural disasters, underwriting cycles, and market volatility. Capital requirements: these insurers must hold sufficient capital to cover potential large-scale losses from natural disasters and other significant events. Regulatory frameworks like Solvency II and RBC adjust capital requirements based on the insurer's exposure to catastrophic and other risks. 3. Health insurance. Risk profile: health insurers manage medical cost inflation, morbidity risk, and regulatory changes affecting health coverage and reimbursements. Capital requirements: Adequate capital is necessary to ensure health insurers can cover high-cost claims and adjust to changing healthcare landscapes. Regulatory frameworks typically consider the volatility of healthcare costs and claims frequency when setting capital requirements. 4. Reinsurance. Risk profile. Reinsurers assume substantial risk from primary insurers, dealing with significant, infrequent events and diverse geographic exposures. They face accumulation risk, where multiple claims arise from a single event, and correlation risk, where multiple events happen simultaneously. Capital requirements. High capital adequacy is essential to cover the extreme tail risks associated with large-scale reinsurance claims. Solvency II and other frameworks often impose higher capital requirements on reinsurers to account for their exposure to significant and systemic risks. Strategies to circumvent regulatory requirements. Compliance with legal and regulatory standards is essential. Circumventing regulatory requirements is not advisable and can lead to severe consequences, including legal sanctions, reputational damage, and financial losses. However, it is essential to understand how regulatory arbitrage strategies may be employed in the financial industry. Some strategies have been observed, but it is important to note that these should be avoided as they are unethical and potentially illegal. 1. Jurisdictional arbitrage. Jurisdictional arbitrage may be done through domicile selection and subsidiary structures. Domicile selection. Companies may establish their operations in jurisdictions with lax regulatory oversight or favorable tax regimes to minimize regulatory burdens and compliance costs. Subsidiary structures. Setting up subsidiaries in multiple jurisdictions allows companies to take advantage of regulatory differences, such as capital requirements, reporting standards, and tax incentives. 2. Regulatory arbitrage. Regulatory arbitrage may be done through structural optimization and product innovation. Structural optimization. Companies may restructure their operations or financial products to exploit regulatory loopholes or exemptions. This could involve complex corporate structures, off-balance sheet transactions, or regulatory capital optimization techniques. Product innovation. Developing innovative financial products or insurance solutions that exploit regulatory ambiguities or inconsistencies to achieve favorable capital treatment, tax advantages, or risk transfer benefits. 3. Compliance avoidance. Compliance avoidance may constitute selective compliance and regulatory capture. Selective compliance. Companies may selectively comply with regulatory requirements or engage in window dressing to create the appearance of compliance while circumventing the spirit of the regulations. Regulatory capture. Attempting to influence or control regulatory agencies or policymakers to shape regulations in the company's interests. 4. Technology-based strategies. Suitable technology-based strategies include algorithmic trading, blockchain, and cryptocurrencies. Algorithmic trading. Utilizing algorithmic trading algorithms to exploit regulatory arbitrage opportunities in financial markets, such as latency arbitrage or regulatory reporting discrepancies. Blockchain and cryptocurrencies. Leveraging blockchain technology and cryptocurrencies to circumvent traditional regulatory frameworks and oversight mechanisms. 5. Legal and regulatory maneuvering. Legal and regulatory maneuvering entails legal interpretation and regulatory lobbying. Legal interpretation. Exploiting legal ambiguities or loopholes in regulatory language to justify non-compliance or circumvent regulatory requirements. Regulatory lobbying. Engaging in lobbying efforts to influence regulatory policies, standards, or enforcement actions in favor of the company's interests. While these strategies may have been observed in practice, it is essential to emphasize that they are unethical and potentially illegal. Regulatory compliance is a fundamental principle of ethical business conduct and is vital for maintaining trust, integrity, and stability in the financial industry. Companies should prioritize transparency, accountability, ethical behavior, risk management practices, and interactions with regulators and stakeholders. Any attempt to circumvent regulatory requirements undermines the financial system's integrity and exposes companies to significant legal, financial, and reputational risks. Hence, discussing the cost implications of circumventing regulatory requirements is necessary. Cost implications of circumventing regulatory requirements. Attempting to circumvent regulatory requirements can have significant cost implications for insurance companies in the short and long term. Here are some cost implications of circumventing regulatory requirements by insurance companies. 1. Legal and regulatory sanctions. Fines and penalties. Regulators may impose fines, penalties, or sanctions for non-compliance or regulatory violations. These fines can be substantial and can erode profitability and shareholder value. Legal costs. Companies may incur significant legal expenses related to regulatory investigations, enforcement actions, or litigation resulting from non-compliance. 2. Reputational damage. Loss of trust. Regulatory violations can damage the company's reputation and erode public trust in its integrity, ethics, and governance practices. Customer attrition. Reputational damage may lead to customer attrition, as policyholders, investors, and business partners may choose to disassociate from the company due to concerns about its compliance record. 3. Increased compliance costs. Remediation efforts. Companies may incur additional costs to remediate compliance deficiencies, implement corrective actions, and strengthen internal controls and compliance frameworks. Enhanced oversight. Regulators may impose enhanced oversight or monitoring requirements on the company, necessitating additional investments in compliance infrastructure, staff training, and regulatory reporting. 4. Operational disruption. Business interruption. Regulatory investigations or enforcement actions can disrupt the company's operations, leading to business interruptions, delays in product development, or suspension of specific business activities. Management distraction. Senior management may need to focus more on core business activities as they devote time and resources to addressing regulatory issues, responding to inquiries, and managing regulatory relationships. 5. Market access restrictions. Regulatory restrictions. Regulators may impose restrictions or conditions on the company's business operations, such as limitations on product offerings, geographic expansion, or acquisitions, limiting growth opportunities and market access. Reputational barriers. Regulatory violations may create reputational barriers that impede the company's ability to attract new customers, partners, or investors, hindering its competitiveness and growth prospects. 6. Long-term sustainability. Strategic implications. Regulatory non-compliance can have strategic implications for the company's long-term sustainability and viability. Persistent regulatory violations may erode shareholder value, impair the company's ability to raise capital or trigger regulatory intervention, including license revocation or business dissolution. Attempting to circumvent regulatory requirements can have far-reaching and costly consequences for insurance companies, including legal and regulatory sanctions, reputational damage, increased compliance costs, operational disruption, market access restrictions, and long-term sustainability risks. Companies must prioritize regulatory compliance, ethical conduct, and risk management to mitigate these risks and safeguard their financial stability, reputation, and stakeholder trust. Compliance with regulatory requirements is a legal obligation and a critical component of sound corporate governance and responsible business practices in the insurance industry. After explaining the cost implications of circumventing regulatory requirements, let us discuss the impact of economic cycles and market conditions. Impact of economic cycles and market conditions on capital adequacy. The impact of economic cycles and market conditions on insurance companies is significant and multifaceted, influencing their financial performance, risk exposure, and capital adequacy. Economic cycles and market conditions can affect insurance companies in the following ways. 1. Premium revenue. Economic cycles and market conditions impact insurance companies' premium income through economic expansion and contraction. Economic expansion. During economic expansionary periods, increased economic activity and consumer spending often lead to higher demand for insurance products, such as property and casualty insurance, life insurance, and health insurance. This results in higher premium revenue for insurance companies as policyholders seek to protect their assets and income. Economic contraction. During economic downturns, reduced consumer spending, business investment, and employment levels may dampen demand for insurance products. Policyholders may reassess their insurance needs and reduce coverage or lapse policies to reduce expenses, leading to lower premium revenue for insurance companies. 2. Investment income. Economic cycles and market conditions impact insurance companies' investment income through interest rates and equity markets. Interest rates. Insurance companies typically invest premiums from policyholders in fixed income securities, such as bonds and treasury securities, to generate investment income. Changes in interest rates, driven by monetary policy decisions or economic conditions, can impact insurers' investment returns and overall profitability. Equity markets. Insurers invest in equities and other asset classes to diversify their investment portfolios and enhance returns. Fluctuations in equity markets, driven by economic indicators, geopolitical events, or investor sentiment, can affect insurers' investment income and asset valuations. 3. Underwriting performance. Economic cycles and market conditions impact insurance companies' underwriting performance through underwriting pricing and claims settlement. Underwriting pricing. Insurers may adjust underwriting pricing and risk selection criteria in response to changing economic conditions and market dynamics. Insurers may become more conservative in underwriting and pricing during economic downturns to mitigate increased risks and preserve profitability. Claims frequency and severity. Economic cycles can influence the frequency and severity of insurance claims. For example, during economic downturns, businesses may cut costs, reduce maintenance spending, or delay investments, leading to increased risk of property damage, liability claims, or business interruptions. 4. Regulatory environment and response. Economic cycles and market conditions impact insurance companies' regulatory environment and response. Economic cycles and market conditions can influence regulatory priorities, policy responses, and supervisory practices in the insurance industry. Regulators may adjust capital requirements, risk management standards, or reporting obligations in response to economic downturns, financial crises, or emerging risks. 5. Capital adequacy. Economic cycles and market conditions impact insurance companies' risk exposure and stress test results. Risk exposure. Economic cycles can impact insurers' risk exposure and capital adequacy. Insurers may experience increased growth opportunities, risk appetite, and capital requirements during economic expansions. Conversely, economic downturns may result in higher risk aversion, capital preservation, and deleveraging strategies. Stress testing. Insurers conduct stress tests to assess their resilience to adverse economic scenarios and market conditions. Stress testing helps insurers identify potential vulnerabilities, quantify capital needs, and develop contingency plans to maintain capital adequacy and financial stability during economic downturns or market crises. Economic cycles and market conditions profoundly impact insurance companies, influencing their premium revenue, investment income, underwriting performance, regulatory environment, and capital adequacy. Insurers must monitor economic indicators, assess their risk exposure, and adapt their business strategies and risk management practices to navigate through different phases of the economic cycle and ensure long-term sustainability and resilience in a dynamic and evolving market environment. Additionally, maintaining strong capital adequacy and liquidity positions is essential for insurers to withstand economic shocks and market volatility, safeguard policyholder interests, and maintain financial stability throughout economic cycles. Next, we discuss the roles of technological advancements in capital adequacy. Roles of technological advancements on capital adequacy. Technological advancements play a crucial role in shaping capital adequacy for insurance companies by influencing risk management practices, operational efficiency, data analytics capabilities, and regulatory compliance. Here are some critical roles of technological advancements on capital adequacy. 1. Advanced analytics. Technological advancements enable insurers to leverage advanced analytics techniques, such as predictive modeling, machine learning, and artificial intelligence, to enhance risk assessment, quantify risk exposures, and optimize capital allocation strategies. 2. Real-time monitoring. Technology allows insurers to monitor risk exposures, market conditions, and portfolio performance in real time, enabling proactive risk management, timely decision-making, and rapid response to emerging risks or market fluctuations. 3. Automation and digitization. Technology facilitates process automation, workflow digitization, and data integration across the insurance value chain, streamlining operations, reducing manual errors, and enhancing operational efficiency. Improved efficiency helps insurers optimize resource allocation and capital utilization to strengthen capital adequacy. 4. Cost reduction. Technological advancements enable insurers to reduce operating costs, administrative expenses, and overheads through automation, digitization, and process optimization, freeing up capital resources for investment in growth initiatives or capital reserves. 5. Data-driven decision-making. Technology enables insurers to harness vast amounts of structured and unstructured data from internal and external sources to gain insights into risk exposures, customer behavior, market trends, and portfolio performance. Data analytics empowers insurers to make informed decisions, optimize capital allocation, and enhance risk-adjusted returns. 6. Predictive modeling. Advanced data analytics techniques, such as predictive modeling and scenario analysis, allow insurers to assess the impact of different scenarios, events, and market conditions on capital adequacy, enabling proactive risk management and capital planning. 7. Regulatory reporting. Technology facilitates regulatory reporting, data management, and compliance monitoring, enabling insurers to meet regulatory requirements, submit accurate and timely reports, and demonstrate compliance with capital adequacy standards and solvency regulations. 8. RegTech solutions. Regulatory technology. RegTech solutions leverage technology to automate regulatory compliance processes, monitor regulatory changes, and facilitate regulatory reporting, helping insurers streamline compliance efforts and reduce costs associated with capital adequacy requirements. 9. Capital modeling. Technological advancements enable insurers to develop sophisticated capital models, stress testing frameworks, and risk aggregation tools to assess capital adequacy, quantify risk exposures, and optimize capital allocation across different business lines, products, and risk categories. 10. Capital efficiency. Technology allows insurers to improve capital efficiency by identifying capital-intensive activities, optimizing risk-adjusted returns, and reallocating capital resources to high-growth, low-risk opportunities. This, in turn, enhances overall capital adequacy and financial performance. Technological advancements play a transformative role in enhancing capital adequacy for insurance companies by enabling more effective risk management, operational efficiency, data analytics capabilities, regulatory compliance, and capital optimization. Insurers that leverage technology to harness data, automate processes, and enhance decision-making capabilities can improve their capital adequacy, resilience, and competitiveness in a dynamic and evolving market environment while meeting regulatory requirements and protecting policyholder interests. Continuous investment in technology, innovation, and digital transformation is essential for insurers to adapt to changing market conditions, regulatory expectations, and customer preferences while maintaining strong capital positions and financial stability. Insurance companies, regulators, policyholders, investors, employees, and other stakeholders play essential roles in the insurance capital adequacy framework. Let us discuss the implications of capital adequacy for these stakeholders. Implications of capital adequacy for insurance companies. Capital adequacy is a critical aspect of risk management and financial stability for insurance companies, with significant implications across various aspects of their operations, performance, and regulatory compliance. Here are some critical impacts of capital adequacy for insurance companies. 1. Solvency. Maintaining adequate capital ensures that insurers have sufficient financial resources to meet their obligations to policyholders, creditors, and other stakeholders, even under adverse circumstances or unexpected losses. 2. Resilience. Adequate capital buffers provide insurers with resilience to withstand economic downturns, catastrophic events, or adverse claims experience without impairing their solvency or liquidity positions. 3. Compliance requirements. Regulatory authorities impose minimum capital requirements and solvency standards to ensure that insurers maintain sufficient capital adequacy to absorb potential losses and protect policyholders' interests. 4. Capital reporting. Insurers must regularly report their capital positions, solvency ratios, and risk exposures to regulatory authorities to demonstrate compliance with regulatory standards and facilitate supervisory oversight. 5. Risk mitigation. Adequate capital allows insurers to mitigate risks, including underwriting, investment, market, credit, and operational risks by allocating capital reserves to cover potential losses or unforeseen contingencies. 6. Capital allocation. Insurers allocate capital resources efficiently across different business lines, products, and risk categories based on their risk appetite, profitability targets, and risk-adjusted return expectations. 7. Market competitiveness. Insurers with solid capital adequacy positions may enjoy a competitive advantage by demonstrating financial strength, stability, and resilience to policyholders, regulators, rating agencies, and investors. 8. Business growth. Adequate capital enables insurers to support business growth initiatives, expand into new markets, develop innovative products, and pursue strategic opportunities, such as mergers and acquisitions, partnerships, or organic growth. 9. Investor relations. Maintaining adequate capital adequacy enhances investor confidence and trust in the insurer's financial health, risk management practices, and ability to generate sustainable returns over the long term. 10. Shareholder value. Insurers with solid capital positions may attract higher valuations, lower cost of capital, and greater investor interest, leading to enhanced shareholder value and long-term shareholder returns. 11. Claims payment ability. Adequate capital ensures that insurers can meet their contractual obligations to policyholders by promptly paying claims, safeguarding policyholders' interests, and maintaining public confidence in the insurance industry. 12. Financial security. Policyholders are reassured by insurers' strong capital adequacy positions, knowing that their insurance coverage is backed by sufficient financial resources to settle claims and withstand adverse events or economic downturns. Capital adequacy is fundamental to insurance companies' financial stability, regulatory compliance, risk management, business operations, investor confidence, and policyholder protection. Insurers must prioritize capital management, maintain strong capital adequacy positions, and adopt prudent risk management practices to effectively navigate dynamic market conditions, regulatory requirements, and economic uncertainties. By ensuring capital adequacy, insurers can enhance their resilience, competitiveness, and ability to fulfill their mission of providing financial protection and security to policyholders and stakeholders. Implications of capital adequacy for regulators. Capital adequacy is a critical consideration for insurance industry regulators, as it directly impacts financial stability, policyholder protection, and systemic risk. Here are some critical implications of capital adequacy for regulators. 1. Systemic risk mitigation. Ensuring that insurance companies maintain adequate capital buffers helps mitigate systemic risk by reducing the likelihood of insurer insolvencies or financial distress that could have broader systemic implications for the financial system. 2. Market confidence. Regulatory oversight of capital adequacy enhances market confidence and stability by assuring stakeholders that insurers have sufficient financial resources to meet their obligations and withstand adverse economic conditions or market shocks. 3. Solvency oversight. Regulators monitor insurers' capital positions, solvency ratios, and risk exposures to assess their financial health and ability to fulfill policyholder claims. Adequate capital ensures that policyholders are protected against insurer insolvencies or failures. 4. Consumer confidence. Regulators play a crucial role in maintaining consumer confidence in the insurance industry by enforcing capital adequacy requirements, conducting solvency assessments, and providing transparency and disclosure to policyholders about insurers' financial strength and stability. 5. Risk-based regulation. Regulators adopt risk-based regulatory frameworks that require insurers to assess and manage their risk exposures effectively, allocate capital prudently, and maintain adequate reserves to cover potential losses. This promotes sound risk management practices and ensures that insurers are adequately capitalized to absorb risks. 6. Stress testing. Regulators conduct stress tests and scenario analyses to evaluate insurers' resilience to adverse events or economic downturns. These tests help identify vulnerabilities, quantify capital needs, and inform regulatory actions to address systemic risks and protect policyholders. 7. Market conduct. Regulators monitor insurers' market conduct practices, pricing strategies, product offerings, and distribution channels to ensure fair treatment of policyholders and compliance with regulatory standards. Capital adequacy plays a role in assessing insurers' capacity to honor their commitments and fulfill policyholder expectations. 8. Competitive landscape. Regulators assess insurers' capital positions and market competitiveness to promote market efficiency, competition, and consumer choice while safeguarding policyholder interests and maintaining financial stability. 9. Supervisory oversight. Regulators oversee insurers' compliance with capital adequacy requirements through supervisory examinations, risk assessments, and regulatory reporting. Adequate supervision ensures insurers adhere to regulatory standards, address compliance deficiencies, and maintain financial resilience. 10. Regulatory harmonization. Regulators collaborate domestically and internationally to harmonize regulatory standards, share best practices, and promote consistency in capital adequacy frameworks across jurisdictions. This enhances regulatory effectiveness, reduces regulatory arbitrage, and fosters cross-border cooperation in supervision and enforcement. Capital adequacy is a cornerstone of regulatory oversight in the insurance industry, with implications for financial stability, policyholder protection, risk management, market oversight, and regulatory effectiveness. Regulators play a vital role in setting and enforcing capital adequacy requirements, conducting solvency assessments, monitoring insurers' financial health, and promoting market confidence and stability. By ensuring that insurers maintain adequate capital buffers, regulators mitigate systemic risks, protect policyholders, and uphold the integrity and strength of the insurance industry. Implications of capital adequacy for policyholders. Capital adequacy has significant implications for policyholders, directly affecting the financial security, stability, and protection insurance companies provide. Here are some critical impacts of capital adequacy for policyholders. 1. Claims payment ability. Capital adequacy ensures that insurance companies have sufficient financial resources to honor policyholder claims promptly and in full. Adequate capital buffers protect policyholders against the risk of insurer insolvencies or failures, ensuring they receive the benefits and coverage they are entitled to under their insurance policies. 2. Policyholder confidence. Insurers' strong capital adequacy positions reassure policyholders, who know that their insurance coverage is backed by sufficient financial strength and stability to withstand adverse economic conditions, market volatility, or catastrophic events without compromising claims payment ability. 3. Risk management. Capital adequacy supports effective risk management practices, enabling insurers to identify, assess, and mitigate various risks, including underwriting risk, investment risk, market risk, credit risk, and operational risk. Strong capital positions enhance insurers' ability to protect policyholders against adverse events, unexpected losses, or unforeseen contingencies. 4. Regulatory oversight. Regulatory authorities enforce capital adequacy requirements and solvency standards to safeguard policyholders' interests and protect them against insurer insolvencies or financial distress. Regulatory oversight ensures that insurers maintain adequate capital buffers to fulfill their obligations and maintain financial stability. 5. Product innovation. Capital adequacy enables insurers to invest in product development, innovation, and diversification to meet policyholders' evolving needs and preferences. Insurers with solid capital positions may offer a broader range of insurance products, enhanced coverage options, and innovative features to attract and retain policyholders. 6. Service excellence. Adequate capital resources support operational excellence, customer service quality, and claims handling efficiency. Insurers can invest in technology, infrastructure, and customer support capabilities to deliver superior service experiences and responsive claims processing, enhancing policyholder satisfaction and loyalty. 7. Market reputation. Policyholders value insurers with solid capital adequacy positions and favorable market reputations, as they perceive them as trustworthy, reliable, and financially secure partners. Positive market reputations contribute to consumer confidence, brand loyalty, and long-term relationships between insurers and policyholders. 8. Transparency and disclosure. Insurers give policyholders transparency and disclosure about their financial strength, capital adequacy, and risk management practices through financial statements, annual reports, and regulatory filings. Policyholders rely on this information to make informed decisions about purchasing insurance coverage and entrusting their financial security to insurers. Capital adequacy is essential for ensuring policyholder protection, financial security, and confidence in the insurance industry. Policyholders benefit from insurers' strong capital positions, robust risk management practices, and regulatory oversight, which enhance insurers' claims settlement capability, improve the quality of products and services, and foster consumer confidence in insurers' financial capacity. By prioritizing capital adequacy, insurers demonstrate their commitment to policyholder protection, regulatory compliance, and long-term sustainability, enhancing trust, loyalty, and satisfaction among policyholders. Implications of capital adequacy for investors. Capital adequacy has profound implications for investors, directly influencing insurance companies' financial health, risk profile, and growth potential. Here is a detailed analysis of these implications. 1. Reduced risk of insolvency. Adequate capital ensures that an insurance company can absorb losses and remain solvent during financial downturns or catastrophic events. This reduces the company's risk of going bankrupt, which is crucial for protecting investors' capital. 2. Stable earnings. Companies with strong capital positions are better equipped to manage unexpected claims and financial shocks, leading to more stable earnings and predictable financial performance. 3. Lower investment risk. Investors are exposed to lower risks when investing in well-capitalized insurers, as these companies are less likely to face financial distress. This lower risk can result in a more stable investment portfolio. 4. Potential for higher returns. While well-capitalized companies might have more conservative growth strategies, their stability can attract a broader base of investors, potentially leading to higher stock valuations and better long-term returns. 5. Enhanced credibility. Strong capital adequacy boosts an insurance company's credibility and reputation. This enhances investor confidence, increasing demand for the company's shares and potentially raising stock prices. 6. Access to capital markets. Companies with robust capital positions find raising funds in capital markets easier, whether through equity or debt offerings. This access to capital can support growth initiatives and value creation for investors. 7. Consistent dividends. Well-capitalized insurers are more likely to maintain consistent and potentially higher dividend payouts, which is attractive to income-focused investors. This consistency can make the company's stock more appealing, enhancing investor returns. 8. Dividend growth. Adequate capital buffers provide the financial flexibility to increase dividends over time, rewarding long-term investors with growing income streams. 9. Avoidance of penalties. Compliance with capital adequacy regulations helps insurers avoid regulatory penalties and sanctions, which could negatively impact financial performance and investor returns. 10. Operational stability. Regulatory compliance ensures the company operates within a stable and predictable regulatory framework, reducing operational risks and uncertainties for investors. 11. Capacity for strategic investments. Adequate capital allows insurers to pursue strategic investments, acquisitions, and expansions without compromising their financial stability. This can lead to growth opportunities and higher returns for investors. 12. Innovation and development. Well-capitalized companies can invest in innovative products, technologies, and markets, driving long-term growth and competitive advantage, ultimately benefiting investors. 13. Higher credit ratings. Strong capital adequacy often results in higher credit ratings from rating agencies. Higher ratings can lower borrowing costs and improve the company's ability to raise capital, positively affecting financial performance and investor returns. 14. Market perception. Higher credit ratings enhance the market perception of the company's financial strength and stability, attracting more investors and potentially increasing the stock price. 15. Protection against economic cycles. Adequate capital buffers help insurers withstand economic cycles and market volatility. This resilience protects investors from significant losses during downturns and positions the company to capitalize on opportunities during recoveries. 16. Stress testing and preparedness. Regular stress testing and scenario analysis, often required by capital adequacy regulations, ensure that insurers are prepared for various adverse conditions, providing additional security to investors. For investors, capital adequacy is a critical factor that influences the overall attractiveness of an insurance company as an investment. Adequate capital enhances financial stability, reduces investment risk, ensures regulatory compliance, supports consistent dividends, and fosters growth and innovation. It also improves market confidence and credit ratings, improving access to capital markets and higher stock valuations. Consequently, well-capitalized insurers provide a more secure and potentially rewarding investment opportunity, making capital adequacy a key consideration for investors when evaluating insurance companies. Implications of capital adequacy for insurance companies' employees. Capital adequacy has several important implications for insurance companies' employees. These implications affect job security, career development, operational stability, and employee morale. Here are some consequences of capital adequacy for insurance companies' employees. 1. Job security. Adequate capital ensures the insurance company's financial stability, reducing the risk of insolvency and layoffs. Employees are more likely to have job security when their employer is financially sound. 2. Employees' retention. Financially stable companies can better retain employees during economic downturns or market volatility, reducing the likelihood of job cuts. 3. Professional growth. Companies with strong capital positions are more likely to invest in employee training and development programs. This investment supports employees' professional growth and enhances their skills. 4. Career advancement. Financially robust insurers often have more opportunities for career advancement and promotion, as they can invest in new business lines, markets, and innovative projects, creating new roles and leadership opportunities. 5. Consistent operations. Adequate capital allows insurance companies to maintain consistent operations even during challenging economic times. This stability ensures that employees can focus on their roles without the distraction of financial instability. 6. Resource availability. Stable companies are better able to allocate resources effectively and provide employees with the tools, technology, and support they need to perform their jobs efficiently. 7. Positive work environment. Financially secure companies tend to have higher employee morale as workers feel safe and optimistic about the company's future. This positive environment can boost productivity and job satisfaction. 8. Motivation and engagement. Employees are more motivated and engaged when they work for a financially healthy company that invests in its workforce and fosters a culture of stability and growth. 9. Competitive salaries. Well-capitalized insurance companies are better positioned to offer competitive salaries and benefits, helping them attract and retain top talent. 10. Incentive programs. Financially strong insurers can provide performance-based incentives and bonuses, enhancing employee motivation and rewarding high performance. 11. Comprehensive benefits. Adequate capital allows companies to offer comprehensive health and well-being programs, including health insurance, wellness programs, and retirement plans. These benefits support employees' overall well-being and long-term financial security. 12. Work-life balance. Financially stable companies are more likely to implement policies and programs that promote work-life balance, such as flexible working arrangements and mental health support. 13. Crisis management. Companies with strong capital adequacy are better equipped to handle crises, whether financial, operational, or related to external events like natural disasters or pandemics. This resilience ensures continuity for employees, minimizing disruption to their work and personal lives. 14. Strategic planning. Adequate capital enables long-term strategic planning and investment, ensuring the company can navigate future challenges and seize opportunities, creating a more secure environment for employees. 15. Regular updates. Financially healthy companies maintain open lines of communication with their employees about the company's financial status and strategic direction. This transparency fosters trust and a sense of inclusion among employees. 16. Employee involvement. Involving employees in decision-making and informing them about the company's financial health can enhance their commitment and loyalty to the organization. Capital adequacy is crucial not only for insurance companies' financial health but also for their employees' well-being and professional growth. Adequate capital enhances job security, career development opportunities, operational stability, and employee morale. It enables companies to offer competitive compensation, comprehensive benefits, and a positive work environment, all of which contribute to higher productivity and employee satisfaction. Therefore, maintaining strong capital adequacy is essential for creating a supportive and thriving workplace for employees in the insurance industry. Implications of capital adequacy for the broader financial system. Capital adequacy has significant implications for the broader financial system. These implications extend beyond individual insurance companies' immediate stability and solvency, affecting financial markets, economic stability, and systemic risk. Let us highlight some of these implications. 1. Mitigation of contagion effects. Adequate capital levels in insurance companies reduce the risk of insolvency and financial distress, which can affect other financial institutions and markets. By maintaining strong capital buffers, insurers help prevent the spread of financial instability. 2. Stability of financial institutions. Insurance companies often connect significantly with other financial institutions, such as banks and investment firms. Adequate capital ensures that insurers meet their obligations to these entities, promoting overall financial system stability. 3. Investor confidence. Strong capital positions in insurance companies enhance investor confidence in financial markets. Investors are more likely to invest in companies and financial instruments when they trust that the institutions are financially stable. 4. Market liquidity. Adequate capital ensures that insurers meet their short-term and long-term obligations, thereby maintaining market liquidity. This helps prevent sudden liquidity crises that can destabilize financial markets. 5. Buffer against economic shocks. Adequate capital allows insurance companies to absorb economic shocks and financial stress without resorting to drastic measures like asset fire sales or significant premium increases. This helps stabilize the broader economy. 6. Sustained economic activity. Insurance companies play a critical role in economic activity by providing risk management and financial protection. Adequate capital ensures they can continue to provide these services even during economic downturns, supporting ongoing economic activity. 7. Consumer trust. Adequate capital in insurance companies ensures they can meet their obligations to policyholders, even in adverse conditions. This builds consumer trust and confidence in the insurance industry, which is essential for the financial system to function properly. 8. Reduced government intervention. Strong capital adequacy reduces the likelihood of government bailouts or interventions, which can have significant economic and political repercussions. It also minimizes the burden on taxpayers and public finances. 9. Improved credit ratings. Adequate capital contributes to insurance companies' higher credit ratings, reflecting their financial health and stability. This, in turn, influences the credit ratings of other financial institutions and entities that interact with the insurance sector. 10. Lower borrowing costs. Higher credit ratings and financial stability can lower borrowing costs for insurers and other connected entities. This promotes more efficient capital allocation and investment within the financial system. 11. Effective supervision. Adequate capital allows for more effective regulatory oversight and supervision of insurance companies. Regulators can focus on proactive risk management and long-term stability rather than crisis intervention. 12. International coordination. Capital adequacy standards facilitate international regulatory coordination and harmonization, promoting global financial stability. This is particularly important for globally active insurance groups and financial institutions. 13. Enhanced risk management practices. Adequate capital encourages insurers to adopt robust risk management practices, which can positively spill over effects on the broader financial system. Improved risk management reduces the likelihood of systemic crises. 14. Support for innovation. Financially stable insurance companies are better positioned to invest in innovative products, services, and technologies. This can lead to improved risk management solutions and more efficient financial markets. Capital adequacy is crucial for the broader financial system as it enhances systemic stability, market confidence, and economic resilience. Regulators and insurers help mitigate systemic risks, protect consumers, and promote sustainable economic growth by ensuring that insurance companies maintain sufficient capital buffers. Adequate capital also supports effective regulatory oversight, international coordination, and innovation in risk management practices, contributing to a more robust and dynamic financial system. The overall impact of capital adequacy extends beyond individual insurers to the health and stability of the entire financial ecosystem. Lastly, we discuss strategic suggestions for insurance companies to ensure capital adequacy. Roles of capital adequacy as a risk management tool in the insurance sector. Capital adequacy is a crucial risk management tool in the insurance industry. It provides a financial cushion that helps insurers manage and mitigate various risks. These include underwriting, market, credit, and operational risks. By maintaining adequate capital levels, insurers can 1. Absorb losses. Adequate capital allows insurance companies to absorb significant losses from unexpected events, such as natural disasters, economic downturns, or large claims, without jeopardizing their solvency. 2. Ensure policyholder protection. Sufficient capital ensures that insurers can meet their obligations to policyholders, paying claims as they are due, to maintain trust and confidence in the insurance system. 3. Enhance financial stability. Insurers contribute to the overall stability of the financial system by having robust capital buffers. This reduces the risk of insolvency and systemic failures, which can have broader economic implications. 4. Facilitate regulatory compliance. Regulatory frameworks, such as Solvency II in Europe and risk-based capital, RBC, requirements in the United States, mandate specific capital levels. Compliance with these regulations helps insurers operate within safe financial parameters and adequate supervision. 5. Support strategic flexibility. Adequate capital gives insurers the financial flexibility to invest in growth opportunities, new technologies, and product innovation while maintaining a secure economic base. Consequently, capital adequacy is integral to insurance companies' risk management framework, ensuring their ability to operate sustainably, protect policyholders, and contribute to the stability of the broader financial system. Strategic suggestions for insurance companies to ensure capital adequacy. Ensuring capital adequacy is essential for insurance companies' financial stability, risk management, and long-term sustainability. Here are some strategic suggestions for insurance companies to enhance capital adequacy. 1. Comprehensive risk assessment. Conduct a comprehensive assessment of all risk exposures, including underwriting risk, investment risk, market risk, credit risk, operational risk, and emerging risks. Identify and quantify risks to determine their potential impact on capital adequacy. 2. Risk mitigation strategies. Implement risk mitigation strategies and controls to effectively manage and mitigate identified risks. This may include diversifying risk exposures, implementing risk transfer mechanisms, for example, reinsurance, and enhancing underwriting standards and claims management processes. 3. Dynamic capital planning. Develop a framework that aligns capital resources with strategic objectives, risk appetite, and regulatory requirements. Regularly assess capital needs and stress test scenarios, and model capital adequacy to optimize capital allocation across different business lines, products, and risk categories. 4. Capital efficiency measures. Implement measures to improve capital efficiency, such as optimizing investment portfolios, reducing capital-intensive activities, and reallocating capital to high-growth, low-risk opportunities. Balance risk-adjusted returns with capital preservation to maximize capital adequacy. 5. Regulatory engagement. Engage proactively with regulatory authorities to stay informed about regulatory developments, capital requirements, and supervisory expectations. Ensure compliance with regulatory standards, reporting obligations, and capital adequacy requirements to maintain regulatory approval and market credibility. 6. RegTech solutions. Leverage regulatory technology, RegTech solutions to automate regulatory reporting, compliance monitoring, and risk management processes. Implement technology-driven solutions to enhance regulatory transparency, efficiency, and accuracy in meeting capital adequacy requirements. 7. Technology and innovation: invest in technology, data analytics, and digital transformation initiatives to enhance risk management capabilities, operational efficiency, and capital optimization. Leverage advanced analytics, artificial intelligence, and automation to improve decision-making, streamline processes, and reduce costs. 8. Product innovation: develop innovative insurance products and solutions that meet evolving customer needs, address emerging risks, and optimize risk-adjusted returns. Explore new markets, distribution channels, and partnership opportunities to expand revenue streams and enhance capital adequacy. 9. Conservative capital management: adopt a conservative approach to capital management by maintaining adequate capital buffers, liquidity reserves, and solvency margins to withstand adverse events, economic downturns, or catastrophic losses. Prioritize capital preservation and financial stability over short-term profitability. 10. Stress testing and scenario analysis: conduct stress tests, scenario analyses, and sensitivity assessments to evaluate the impact of adverse events, market volatility, and economic shocks on capital adequacy. Use stress testing results to identify vulnerabilities, set risk tolerances, and enhance capital resilience. By implementing these strategic suggestions, insurance companies can strengthen their capital adequacy, enhance risk management practices, ensure regulatory compliance, and position themselves for sustainable growth and resilience in a dynamic market environment. Continuous monitoring, evaluation, and adjustment of capital adequacy strategies are essential to adapt to changing market conditions, regulatory requirements, and emerging risks while maintaining financial stability and protecting policyholder interests. Conclusion: capital adequacy is a critical concept that underpins insurance companies' financial health and stability. It encompasses various regulatory and internal measures to ensure insurers can withstand financial shocks, protect policyholders, and maintain market confidence. Regulatory changes significantly impact capital adequacy in the insurance industry, influencing insurers' capital positions, risk management practices, market dynamics, and policyholder protection. By imposing higher capital requirements, enhancing risk management standards, and promoting market stability, regulatory changes aim to strengthen the insurance sector's resilience and strength, ultimately benefiting policyholders and the broader economy. Insurers must adapt to these regulatory changes by maintaining strong capital positions, implementing robust risk management practices, and remaining vigilant to emerging regulatory developments. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial, please give it a thumbs up and share it with your friends. Thank you for seeing the Solomon Fadden, Risk Management of Everything videos. I love to hear from you. Please post your comments and questions in the comments section below. If you are new here, subscribe to the channel, Solomon Fadden, Risk Management of Everything's channel, and press the notification button to be notified when new videos are uploaded. Thank you.